Down yesterday, 119.21, yields are higher on the morning by about a basis point. They are well off the highs of the year of pushing 170, 180 on a 10-year at the back end of March. Right now, 186.38 on 30s. The real question for me at this point is, can you really look at a treasury market in a vacuum focused purely on the fundamentals in one country when this is happening elsewhere? Switch up the board and get to the Bund curve. 2s, 10s, 30s. Every single part of this bond market in Germany yesterday was negative. Yeah. With the 30-year yield below that zero line, Tom, for the first time since February, and right now 0.005%. I just don't think you can, and many people agree because it's just stated the obvious. You can't take the Treasury market and say it trades purely on the fundamentals of the U.S. economy when you've got this happening everywhere else.
John and I channeling this morning. I look at the Swiss 20-year as a proxy on that. And, John, what's so important here is they're really buttressed about good, new lows, new greater negative. It's a little bit different than what we see in the United States.
Yeah, just breaking down over in Germany. And Tom, we were talking about maybe getting closer to zero on a German 10-year, and we're back to negative 47, which is basically in line with the policy rate of the ECB of negative 50 basis points.
It speaks to the economy's under view here. And, of course, Jobs on Friday will give us the American view, a real update there. Right now on that report, Joseph Livornia joins us with the Taxes CIB, their chief economist for the Americas in his public service at the White House recently. Joe Livornia, I want to talk to you about the mystery of this August, the mystery into Q4 as well. How opaque is your Q4 right now?
It's somewhat opaque. Look, the economy's done very well in the past 4 quarters. GDP growth has been over 12%, but I've been of the view that the economy was at peak growth around Q2 and things are going to moderate. But even so, Tom, it's hard to see growth still not being really robust in the 4th quarter. I'm more worried about growth in 2022, and that's what the U.S. Bond market and global bond markets are sensing, that growth is going to weaken quite sharply with this bull flattening. And inflation will be transitory. That's what the markets are telling us.
That's what the markets are telling us. And is it a weakening back to potential GDP or let's say 3%? I mean, what's the level of weakening, the scale you would presume?
This year growth, I thought coming in we'd have growth at 7, maybe even 8%. But next year I'm thinking growth is only 2%, maybe even less. Wow. Which isn't far from the administration's longer term forecast. And that reflects the fact that we're borrowing from the future because we've had people that have been unable to spend until recently because of the pandemic. They've been locked up. They brought spending forward. We see that in goods purchases, which are about 4 to 5 points above their long-term GDP trend. And it's been predominantly consumption-led. Consumption in the last 14 quarters, if you look at 14 months rather, Tom, from when the savings rate went from 34% now down to 9%, we've had annualized consumption gains of 21% real. That's amazing. It's mostly in goods. So we're borrowing from the future, and that's why growth next year will slow quite sharply.
Joe, let's take your view of the world, and I'll ask you a basic question. How do you think the Federal Reserve operates in the kind of environment that you've just described?
They don't do anything, Jonathan. They stay on hold. They continue to pump liquidity in the system. They don't taper. They don't tighten. What we've seen continually since those late March, early April highs in 10-year yields is the market pricing the terminal rate significantly lower. That five-year OIS we've talked about was around 240 back in early April, thinking the market would basically, or the Fed rather, would tighten rates like they did in the last cycle. And just the other day, we were below 150. So the market's thinking the Fed does nothing. And my guess is we don't get a tightening until after the next presidential election.
John, and then this goes right to the heart of what you mentioned before, which is the gentleman from St. Louis disagrees, just flat out disagrees with Joe Livornia.
As does the former head of research, I imagine, over at the St. Louis Fed as well. Joe, you said
that's okay. I don't mind being the other side of that trade.
I imagine you don't mind that at all. You said no tightening, no tapering. You don't think we get a taper here, Joe, at all?
Not until we know what the contours of a budget deal look like, because the Fed will treat a lack of a deal as being contractionary. And even though we're in the midst of debating what happens on the infrastructure side, the bigger part of the package is this family welfare bill. And we're not going to know what that looks like if we get it, and it will likely be through reconciliation until maybe mid-October. Early November. So, no, I think the Fed's going to sit and wait, see how things evolve. And it's going to be really hard, Jonathan, for the Fed to taper in a slower growth environment, and especially if over the next few months job growth slows, which I expect as well.
Just fascinating. Joe and Lisa, this won't be lost on you. No tapering. The other call there, no rate hike until after the next election.
Yeah, I just want to add one other thing. That sounds aggressive, but if you look at the last 2 cycles, the average time from the last rate cut to the first rate hike was 7 years. So this isn't really that unusual if you look at the last couple of cycles.
So, Joe, why are some people wrong who are saying that the balance of risks is too much higher inflation, especially with the Fed so dovish and so willing to wait? What is wrong with that call? Because it seems like you disagree.
Yeah, well, the thing is, we've never had basically a global lockdown of the economy where we've gotten these bottlenecks. And of course, demand has been much stronger than people expected. The government has provided a tremendous amount of assistance. So it's easy to see why prices are rising. If there's a concern on inflation, and if I'm wrong on inflation, it's because perhaps we just spend too much. This is sort of the Larry Summers argument. And maybe evidence of that is seen in what the CBO next year was saying the output gap looks like. They're forecasting an output gap of almost 240 basis points, meaning the economy is 2 points above its long-term potential. That's the highest since 71. So it is possible, if we get more fiscal stimulus, you could build this inflation dynamic in the system. But I think most people just aren't fully appreciative of the unique situation we're in, and the fact that much of the liquidity we've had to this point has gone into assets, both equities and, of course, real estate.
Joe, I hate to use the word transitory, but let's talk transitory. And at what point you start to look past some of the near-term influences on the economy? I'm talking about supply chain disruptions. The gentleman from St. Louis, as Tom said, was highlighting this as one feature that forces monetary policymakers to be more nimble. How do you factor in some of these disruptions that seem overly persistent and persisting longer than many people had expected?
Yeah, I would just give it time. I mean, the thing is, we saw with lumber, for example, which was the poster child for bottlenecks, where prices have basically collapsed as the mills were able to reopen. And I've argued we're going to see that more on the semiconductor side and other parts of the economy. It just needs to take time. The expectation side of it's important. And when we look at the tips curve, that tips curve is actually inverted. So it's not to say the markets are always right. There's just no evidence that anybody believes this is permanent. And because expectations oftentimes can be self-feeding and self-sustaining, those expectations are very likely to keep inflation low. And then as supply comes on, you'll start to see those prices moderate.
Joe, none of this is in the economic textbooks at Vassar. This is all absolutely original that we're dealing with right now. How do you interpret the real yield? Are you looking at the nominal rate? Or are you taking out the inflation expectation? Which of those two dynamics will adjust the real yield?
Well, I would say just focus on the real yield. The real yield has been falling as inflation expectations have edged up a bit. And that's sort of evidence, Tom, right there. The market does not believe that you're going to have very, very strong growth going forward. It's I hate to say these words, but it's the secular stagnation thesis. That's really what the market's saying. And you see it more broadly just in the slope of the curve, as you highlighted, both in the U.S. and Germany and elsewhere. You've got a bull flattening of the yield curve. So that's really not an inflation story. It's a growth story. And of course, equities benefit from the fact that there aren't any alternatives, and there's a tremendous amount of liquidity in the market.
Joe, fantastic to catch up. Some really interesting calls there. Joe Livornia, really good to hear from you, sir. The T6 CIB Chief Economist for the Americas. Within 24 hours, we've had two widely different views. Stephen Stanley of Amherst Pierpont looking for the first hike of June next year. And then you've got Joe Livornia there, Tom, talking about no hike through the entirety of this first administration from President Joe Biden.
Yeah, well, and it's the in-between that's of interest as well, John. I just think it shows where we are and how original this natural disaster is that we're living. And I'm sorry, I'm not into giving an opinion here in any way, shape, or form. We don't know.
Following the data, and I have to say highly anecdotal, but some of the signs that came out of yesterday's ISM, slightly encouraging in the industry commentary that we got, Lee. So this line stood out for a lot of people at least. Supply chains are slowly, very slowly filling up like a water hose starting upstream and slowly flowing downstream. Rumor is a full return to normal, maybe nearer to year's end, but the situation is progressing. We need to hear so much more of that for the next several months.
You also saw a moderation in how much prices were going up. Just to speak to that point, this idea that some of these pressures do seem to be moderating and really speak to Joe Livornia's point, which is that these issues are temporary. I do just want to say, though, that it all depends on inflation, what you think the Fed will do, and whether we're in a new regime or we're going back to an old one, where it's a series of lower lows when it comes to the neutral rate, just based on how much debt there is, John, and how much there is to risk if you raise rates too quickly.
Well, clearly, Joe thinks we're going to be waiting, Tom, a long, long time.
Yeah, I could wait a long, long time. I mean, I don't think that really outlines what he said, John. A long, long time for Joe Livornia is an outlier.
Through 24 and into 25. Yeah. Look, we went there last time around, didn't we?
Well,
took a long time to wind things down.
Come on, it's a great missed call, John. It's a great missed call of the last number of years.
Well, look, Tom, the issue that people are raising this time around is that we have a set of policymakers conditioned by the previous cycle, who are implementing policy based on the mistakes they made previously for a cycle that is radically different and moving at a very different pace. That's the argument anyway.
When yields broke yesterday, you and I were looking at 2-10 spread to go to 0.99. I mean, that's where we are.
Yields right now still sub 120 on 10s, 119.71. From New York City this morning, good morning. Alongside Tom Keane and Lisa Abramowitz, I'm Jonathan Ferro. Futures up 17. We advanced 0.4% on the S&P. In the FX market, euro dollar firmer by about 0.1% and change to 118.86. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden and top White House officials are trying to stave off a wave of evictions. A federal moratorium on evictions just expired, and the president is pressing federal, state, and local government agencies to act quickly to stop tenants from losing their homes. The chair of the Securities and Exchange Commission is preparing more oversight of cryptocurrencies to protect investors. Gary Gensler has unusual expertise in digital assets, but in an interview with Bloomberg, he signaled that he's not on board with the hands-off oversight approach many enthusiasts would like to see. He says that investors must be protected against fraud. A Labour union may get the chance to reverse its loss to Amazon. Bloomberg's learned that a federal official has recommended overturning the results of a union election at an Amazon warehouse in Alabama. The National Labor Relations Board hearing officer says the election should be run again. Amazon can appeal that decision. The union accused the company of making anti-union threats. And Standard Chartered overcame economic headwinds across Asia to beat second quarter forecasts. That's allowing the bank to buy back shares and plan a small dividend. Standard Chartered's bottom line was boosted by reduced credit losses. Meanwhile, the wealth management unit posted a 26% increase in operating income. In China, shares of Tencent fell as much as 11% today. An offshoot of China's official news agency referred to video games as spiritual opium and electronic drugs. That stoked fears that Beijing will next set its sights on online entertainment. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
ask me all the time, what is the key to being a really good investor? I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Some of the best deals in history have been passed on by a very large number of people. The money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Strongly recommend that people wear masks in indoor settings, even if you're vaccinated. Now, this is particularly true, of course, if you might be around anyone unvaccinated.
I believe it's in your business interest to run a vaccine-only establishment. It's very simple. You can operate a restaurant and just say you have to show that you were vaccinated when you walk in the door.
New York City Mayor Bill de Blasio and New York Governor Andrew Cuomo on a difficult moment for this country. Another shift in the past week. From New York City this morning, good morning. Alongside Tom Keene and Lisa Browitz, I'm Jonathan Ferro. Your equity market, the S&P up 0.4%, advancing 16 points. Into the bond market, yields higher by a couple of basis points. Still sub 120 at 119.54. And the euro trying to get back to 119 again. Euro dollar positive, almost 0.2%. TK euro dollar 118.89.
Yeah, I like watching euro there. Through 119 is a big deal, John. A test of 120 would be a huge deal. The other thing I'd note here is the VIX 18.69 shows a stasis before the American labor reports of Wednesday, Thursday, and Friday. This is an honor. Christopher Bayror is someone who puts travel to work out of Hobart and William and Smith College ages ago and downstate. He holds court at Johns Hopkins in the Bloomberg School of Public Health, is a lead epidemiologist. We're thrilled that Dr. Bayror, with his international perspective, could join us this morning. Let me go local if I can, Dr. Bayror, which is the idea of the mayor of New York City and the governor of New York State saying, public enterprise, get your act together. Is there a history in a pandemic that public enterprise can provide public health policy?
Well, what we really, of course, want to see is the federal government leading on this to have consistency across the states. But we've never had that in response to the coronavirus. And so I think what you're seeing is that people are reluctant to speak to the need for national mandates on masking, on immunization. And so it really has been up to much more local entities and the private sector to step in. I think what you're seeing is that we know these vaccines are highly safe and effective. These are the vaccines with emergency use authorization. And our only way out of this is much higher immunization rates than we've been able to achieve. But in the absence of doing better on vaccines, we are going to see things like vaccine mandates in the private sector.
If a senator, Mr. Graham, if a pitcher, Mr. Cole of the dreaded New York Yankees, if they get COVID, but we rationalize that they'll be fine, how does that fit into this mix?
Well, the important thing to remember is that these vaccines are holding against the variants in terms of hospitalization, pneumonia, death. But as it turns out, people who've been immunized can still get COVID, as Senator Graham did. And unfortunately, it looks like they can also transmit it. So they're likely to have a mild, much attenuated course, but still to have it. What that means is masking is still important. The senator is self-isolating now for 10 days. That's the right thing to do because he could very well be infectious for others. What's not happening is that he's not getting pneumonia and he's not in the hospital. When we look at who is in the hospital and who is on a ventilator, it's overwhelmingly the unvaccinated. And that's a tragedy.
Dr. Byrer, we've heard from Tony Fauci of the National Institute of Health that we're probably not going to see additional lockdowns, and yet in Florida we're starting to see constraints on hospital staff as they deal with a surge in intake and patients coming in their doors. What's the potential threshold at which point this becomes a public health problem once again? We don't want to go back to a time when you're starting to set up tents and hospital beds outside in order to deal with the capacity.
Well, we were down to about 12,000 infections a day. We're now back to 80,000 infections a day. And that is largely because of this much more infectious Delta variant. We had seen really a stalling in the vaccine effort, but it has been picking up in the last 2 weeks or so. Fortunately, people are really starting to move. As far as lockdowns and shutdowns, I think Dr. Fauci is generally right, but the exception to that is likely to be where vaccine coverage remains too low, places like Florida, other states in the South. We've already seen Missouri and Arkansas with low immunization coverage having high hospitalization.
Yeah. Dr. Byrer, the emotional effect of going back to wearing masks was actually greater than I thought. I was speaking with my colleague here about that. A lot of people wondering, are we going back to an era that seems endless the way it did a year ago? And there's a question, how long has the pandemic been prolonged as a result of the Delta variant?
Oh, there's no question that it's been prolonged. It's not just the variant. The reason that these variants can emerge is because there are so many susceptible people out there. And we have to remember that as challenging as this is in the US, in much of the world, there's virtually no efficacy, no high efficacy vaccines available. People are using the Chinese vaccines, which are not holding up well against this variant. They're using AstraZeneca, which also doesn't hold up as well. So what we really need is high efficacy vaccines with high uptake. Otherwise, we're going to see more variants. There's already a new Lambda variant that is emerging that may be a variant of concern. This is going to keep happening as long as there are so many susceptible people. So our way out of this is to do much better with immunization and to do much better with the high efficacy vaccines, the mRNAs and the J&J.
Doctor, just quickly, is the experience of the UK in the last couple of months a decent template for the United States?
Well, I think you're seeing there, Britain is already thinking about and moving toward a booster because of concerns about waning immunity and the need to protect the population. Apparently, China is also looking at boosting with an mRNA. Israel is planning on looking at a booster.
The reason I ask that, of course, Doctor, is because cases have rolled over quite significantly over the last couple of weeks. And that's what I mean by saying, is the UK a decent template for what we might experience here in the next several weeks through August?
Well, it certainly could be for much of the country. The immunization rates have been high in the UK. We still have areas that have much lower rates of immunization and where the UK might not be a good template, like Florida.
Interesting. Doctor, appreciate your time, sir. Thank you. Dr. Krista Byrer, Johns Hopkins Bloomberg School of Public Health professor and epidemiologist. Your equity market looks like this, up 16 on the S&P, advancing a third of 1%. For the market strategists out there, Tom Keene, there are many, including Morgan Stanley, who look to the UK as a template for the United States. And for that very reason, many people in this market still constructive about the near term, because of exactly that.
Yeah, well, I think the constructive wing is tangible in the developed world. It's still there. But to me, John, it's news day every day. And I think the significance yesterday of Mayor de Blasio and Governor Cuomo reading the riot act to the restaurant business to get their act together, vaccinated, unvaccinated, was really critical, certainly for the Eastern Seaboard.
Do you think the mayor of New York City has a decent relationship with private organizations, private companies, Tom?
Oh, it's
to try and make that happen?
I think it's sterling. I think it's a sterling
relationship.
It's good enough? Yes.
Ooh, the sarcasm.
Isn't that sad, though, that for the moment we're in right now, Tom, that relationship would really matter? It would really count, and it hasn't been built up. Lost for words. Okay.
Silence.
You tell me in a commercial break what you really think. Tom Keene, Lisa Bramage, Jonathan Ferro. Joining us shortly, Anna Han of Wells Fargo. Equity futures up 16.
We should get a Parcheesi
advancing
board.
4/10
really?
of 1%. On the S&P 500. John Stolfus of Oppenheimer looking for 4,700 on the S&P. From New York City this morning, good morning. This is Bloomberg.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tierney Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance and more.
2022年完成空间站的在轨建造，建成国家太空间之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station.
出发，是，敬礼。
China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Had an exceptional Q2. It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
I would argue the labor market is as tight, if not tighter, than any we've seen in decades.
We're already in an economy that has seen peak growth on a quarter-to-quarter basis and is beginning to slow.
We're seeing a Fed that's moving a little bit faster, a little bit further to pull back on these purchases.
The market kind of has this view right now that if the Fed starts hiking, they will not be able to get many rate hikes actually done.
It takes markets a long time to realize that something really fundamental has changed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market up 17 on the S&P, advancing 0.4%. We've had a little look at 4,400 over the last month or so, Tom, on the S&P. The calls keep coming through, 4,700 from Oppenheimer in the last hour on this program.
Well, the lift is there, and that's a measured lift out, a measured amount of time. Of course, 5,000 is a big figure for Standard & Poor's 500. John, a Dow equivalent to SPX 5,000 is just under Dow 40,000. Call it 39,500.
Thanks for that value add.
But seriously, John, nobody's framing this. Nobody's framing out beyond Q4, maybe summer of next year.
Well, let's frame the debate right now. We had a guest on this program yesterday, Tom, Stephen Stanley of Amherst Pierpont, saying first hike June next year.
Yep.
We had Joe Lavorgna of Natixis on this program 30 minutes ago saying first hike, it's not going to happen through the next 3.5 years. They are radically different calls, and both individuals are looking at exactly the same economic data.
You fold that into the markets, John, into the rate market where money's made and lost, but particularly into the equity market, and it's a vision thing that surveillance is struggling with now. Here to the end of the summer, and I would say into autumn. We got to get through August, but then how do you frame June of next year? And the answer is, if you're a bull, you go to SPX 5000.
Yeah, I kicked off yesterday by kicking off the month of August by saying, Lisa, this is the road towards September. That's all August is.
Yeah, although you hear from Fed officials that maybe September is the road to October when we get the data for September.
If you're Governor Brainerd, yes.
I mean, that's the issue, is at what point do you have a world that you can look at and actually assess? And really the key metric here is inflation. People wondering, and really the dissonance that you're seeing on the sides of a rate hike next year or a rate hike in 3.5 years is, are we going to get a new inflationary regime post-COVID, or are we going back to the old regime and then some with the load of debt that we have hanging over us?
Is it fair to say the week starts tomorrow? Vice Chair Clarida Tom coming out tomorrow with a speech. ADP report claims Thursday, payrolls Friday.
No, the Clarida speech has got to be there, because is he going to put Boulder in the timeout chair? I mean, that's what this comes down to.
Does he bring Jackson Hole alive again after Governor Brainerd poured some freezing cold water over it over the last week too?
John, are you selling you need a trip out to Jackson Hole?
No. I won't be around for Jackson Hole. Your equity market up 16 on the S&P.
Imagine
S&P 500 futures up 0.4 of 1%. Nobody needs to see that. Yields are higher by a basis point or two to 119.21. And euro dollar, Lisa, having a little look at 119 again, up 0.1% on that currency pair. Euro dollar positive. The euro 118.85.
John, that was kind of ominous. I won't be around for that. I mean, you're going to be on vacation. It's not a serious thing, unless you want to go.
Not as dark as you. No one took it that way.
All right, let's move on.
Please do.
10 a.m. We get U.S. June factory orders and durable goods orders. Interesting to see the demand from factories. Also, whether we start to see some of the inventories build up, whether orders continue to be strong. Really, again, a key measure on some of these supply chain disruptions. Are they starting to ease in tandem with what we saw yesterday in the ISM manufacturing survey? Let's not overstate it. Easing a little bit, but still a good trajectory. Also today, throughout the day, we're going to get U.S. July awards, total vehicle sales. The key issue here is how much are they slowing because of a lack of inventory on dealership lots? And this has been a theme. We hear that the road ahead is going to be rocky because there continue to be auto chip shortages. Is there any sign of that rolling over? Also, what are some of these sale prices like? This is what's kept profits very high despite some of the shortages that we've seen. And 3:45 p.m., President Biden is planning to speak on COVID-19 and the pace of vaccinations throughout the country. Interesting to see what he says about mask mandates, also trying to pressure the private sector, John, to take a more active role in mandating vaccinations for access. We see them looking to the private sector to take the lead role, as frankly, it continues to be a mystery as to what the legality of a federal mandate really is.
Lisa? Really important stuff still ahead of us. Thank you. We talked yesterday about the comments coming from the team over at BMO on the bond market. The extent to which treasuries will be driven by the fundamentals is as much of an unknown as the actual data itself at this stage. This is the line from Wells Fargo on the economic data. Economic data continues to be in the eye of the beholder. Anna Han joins us now, Wells Fargo Securities equity strategist. So Anna, let's talk about that. What does it mean for an equity investor, the incoming economic data of the moment?
I think what it means for us is that it can be interpreted sort of how you want to see the picture. In the eye of the beholder, what I mean by that is that sometimes you look at this economic data, you can be really concerned. Is growth slowing down? Is the amplitude of future economic GDP growth slowing down? Will that extend the cycle? And in that case, is that a concern on why maybe real yields are pulling back? Because people have a concern about whether full employment can be reached sooner. On the other hand, there are a lot of still bright spots in that economic data that support this reflation trade. I think it depends which camp you're in.
And your research note is fascinating in its physics, where you talk about amplitude. I want to take it over to an even larger idea of magnitude. For the bulls out there in the equity market, what are the magnitudes that get you out to the emotion of SPX 5000 or the emotion of Dow 40,000?
You know, those are big, beautiful, round numbers, Tom, and people love those shiny numbers. I think to get there, what you really need to see, maybe two fronts. One is that when you have these kind of yields retreating, you see this kind of natural effect for a discounting model for equity growth, for equity earnings. But on the other hand, that comes with this sort of ominous side of, well, growth is slowing down. Is it sustainable? But to get that yield, people may be reaching into equities. On the other hand, to really push equities, and I think what's been driving it more recently is expectations and estimates. As we've gone through earnings season, you've seen corporates very focused on what do these input costs mean for my margins. And for the companies that are able to pass along that price and those margins can remain fat, then you see that they're able to continue seeing some price appreciation. I think it's that upward expectation and estimate revisions that we're really keeping an eye on to get there.
And specifically, just to dig in a little bit more, Anna, you noted in your recent research that earnings estimate revisions continue to trend higher, especially for value sectors. So why is this not being reflected in outperformance of these particular areas when you see growth surge ahead over the past month or so?
I think growth surgence recently has been a bit of that move in nominal yield. And what's interesting is that nominal yield move has been driven by real yields, but the inflation expectation baked in, at least the 10-year, has remained, well, rather steady. So you see this growth trade has had resurgence as yields pull back. The question for these value stocks is this reflation going to be a concern? And that uncertainty, I think, still weighs on it, that additional risk premium that you have to bake in. But when you look at estimates, you're right. These value sectors are really what's pushing the estimate revisions. And if that continues, and if that expectations or these revisions can continue outpacing what investors want out of it, I think you will see that eventual appreciation later down the road.
And what leads to the downdraft? You and the team with Chris Harvey looking for 3850 on the S&P. We've had the 4700 view just about an hour ago. What's the 3850 view?
Well, if you remember us coming into the year, we talked about low volatility and defensive strategies come summer. And look what's happened in the recent month. We recommended a tactical pivot into low volatility strategy and style because a pullback in yields could cause some of that volatility. And for us right now, it's not that necessarily our longer term view on reflation has yet changed, but we like to say, be careful of perception becoming reality. Once the market really starts to doubt the potential for reflation, the potential for growth, that can kind of spiral out of control. So for us, the reason we remain cautious is that we're seeing signs of concern, and that can really have a sort of negative and spreading effect amongst investors. So it keeps us a little bit more cautious and on our toes.
Earlier this year, Anna, we were pointing to retail investors as the potential swing trader when it came to certain big moves in equity markets. Are they still players, or have they all gone back to taking vacations and not dealing with the Robinhood accounts?
Well, I think they are definitely still a player, and they may be even growing as we go several years forward. However, for now, I think a lot of the flows you're seeing and that's been dominating more in the fixed income markets has been more institutional side, has been your bigger fishes or whales in the ocean here. But when you look at equities, a lot of this sort of risk-taking or risk seeking was pulled back last month, given the additional concern about potential for full employment to be a bit further down the road. And as that risk appetite wanes, I think you may see the retail crowd be a little quieter and maybe may sit down a little bit in the stands.
Anna, good to catch up. Always good to hear from you. Anna Han there of Wells Fargo's equity strategist with Chris Harvey and the team, looking for 3850 on the S&P 500 year-end, Tom. Once again, framing out the story to 3850 all the way through to 4700 on this program over the last couple of hours.
You know, it's healthy to see this, and frankly, John, in the dead of summer, maybe that's what you see, but this isn't a normal summer. And again, I go back to maybe what we'll hear from Vice Chairman Clarida, that they are beyond data dependent. He'll phrase that in his own elegant way. But, I mean, they're hanging on every data point.
How close will Vice Chair Clarida's speech be to what we heard from Governor Brainerd on Friday going into the weekend? Lisa, I think that's the big question for this market. If we get a Governor Brainerd-type speech from Vice Chair Clarida, that's a big deal.
It means that perhaps he's aligning himself with someone he sees as being the next Fed chair. I mean, how much does that
you went straight to the politics. I was going to the markets, but carry on.
I mean, well, the idea is, where is the balance of weight? We were talking about the big three, right? Rich Clarida, John Williams, and Fed Chair Jay Powell. Well, at this point, does Lael Brainerd become one of the big four as she starts to step to the seat?
I think anyone on the Board of Governors should be on the same page. Typically, they are. That's not my view. I think many people believe that is the case, Tom. that they're all on the same page. And that's why the speech from Governor Waller, the interview with CNBC yesterday, was quite interesting to see him break with the core of the Fed.
You two are all Bridgerton. I mean, Lisa, you're looking at the Fed like it's an episode of Bridgerton.
I've never watched Bridgerton.
I mean, that's all there is to it.
Lisa has. Lisa, can you say this is like an episode of Bridgerton?
I don't know what you've been watching, Tom. This is not like Bridgerton at all. What's in that tang?
That is not an episode of anything I want to watch. Bond market, Fed drama. I'll take a pass. Yields higher by a couple of basis points to 119.54. Equities up 0.4%. I don't know if that's a good thing or a bad thing, Tom. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. The surge in COVID cases is increasing pressure on U.S. drug regulators to fully approve the Pfizer coronavirus vaccine. It was the first one to apply for the full licensure in the country. Approval could help the Biden administration ramp back up its immunization drive and reassure vaccine holdouts that the shots are safe. A key Senate Republican has tested positive for the coronavirus, and that could delay the Democratic plans to pass that infrastructure bill this week. Senator Lindsey Graham and at least 4 other senators attended an event over the weekend hosted by Senator Joe Manchin. Graham will quarantine for 10 days and miss votes on the legislation. And if other senators test positive, well, that could mean they delay the vote timetable altogether. At the Tokyo Olympics, American gymnastics star Simone Biles made an emotional return to competition and ended up winning the bronze medal in the balance beam final. That came a week after she withdrew from several events to focus on her mental health. The bronze was Biles' 7th career Olympic medal. She won it by drilling a slightly watered-down version of her usual routine on the beam. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What you said was we need to make them in America. Does that include overseas companies making them if they have the plant in America?
I would certainly be in favor of them having operations in America, absolutely. You know, Samsung, TSMC, there are companies that are in allied countries, and we certainly want them operating in America and producing chips in this country, yes.
So we have a significant chip issue, but there are other supply chain issues as well. As I know you're monitoring what's going on. Where have you seen other problems in the supply chains right now in the United States that need to be addressed?
Particularly in home building supplies, lumber and all the related supplies, glue, adhesives, and you see it playing out. Home prices are high. If you go to Home Depot or Lowe's, you'll see prices are a little bit high, and that's all because of the lack of supply, just disruption.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Talking about a $550 billion package. Honestly, who knows where this is going to end up? I mean, the conversation changes week to week. But at this point, I think that the market's expectations for another large fiscal plan have been dampened to some degree.
That was Lisa Hornby, Schroders head of US multi-sector fixed income. Thank you, Tom. You were part of that. Tom Keene, Lisa Abramovich, Jonathan Ferro, your equity market. You're on Real TK. Equity futures up 15. We advance 1/3% on the S&P into the bond market where yields are higher by a basis point or two. A breakdown yesterday, 119.38 this morning, still sub 120. Euro dollar, Tom, positive 0.1% and change. Euro dollar 118.89.
Yeah, we haven't talked, John, yet about the curve flattening yesterday through 100 basis points. The difference in yield between the 10-year and the 2-year over less than 1 percentage point. And, John, we didn't get down to where we were like July 17th or whatever.
No.
But I'm sorry, it's a big deal to break 100 basis.
It's odd. I mean, we've talked about this so much over the last few months. Yeah. Guessing the data is one thing. Guessing how the market will respond to the data is quite another and really difficult to do. It was a downside surprise on the ISM, okay. But when you broke down the ISM, really robust demand still, some really subtle signs that supply constraints were easing. Those are the kind of things we want to see. I don't know, Tom. Yeah. What do you think?
Tom Purcelli wrote a note on that saying it was better than the gloom that was in part of
beneath the surface, yes, I agree.
Yeah. I don't
short squeeze. That's what a lot of people were saying.
Is that what they're saying? Still, Lisa, though.
Still, which is the shocking thing, the idea that there still are shorts to be squeezed out.
That's been the excuse for the last several months. Okay. I mean, I'll go there. Your 10-year 119.38. I'll go anywhere with this bond market right now, Tom. I've got no idea.
Jeff Fitzpatrick is like, what are they talking about? He's in Washington. Jack Fitzpatrick, our Bloomberg government reporter, and joins us this morning. Jack, I got to stay on plan here. There's always a wacko issue that comes in every summer in Washington. It's eviction, and I guess we can make a joke about it, but this is really serious, isn't it? Are there going to be people out on the street?
Yes, as it stands right now, there's not really much of a plan from the executive branch or Congress to deal with this. The president, speaking about this yesterday, did note that states are taking action to the extent that about 1/3 of the people who would be evicted are not going to because of their own state measures. But really the list of things the president is trying to do in an announcement yesterday is not totally concrete, pushing states to take action, trying to get previously allocated money out. That has been a big deal.
Right.
Right now, there's not an extension of the moratorium, and the Supreme Court had made it pretty clear that the Congress actually needs to act on that, and the House is done.
Well, that would be my Civics 101 is where's Congress? But is this a debate about this pandemic, or is this a debate about welfare and Washington going back to the days of William Jefferson Clinton?
This one, I think, is pretty clearly more its own issue today. It's not extremely ideological. Even on the Republican side, a lot of the criticism I heard was just that the administration sat on its hands and waited way too long to tell Congress that it needed Congress to act. And meanwhile, they tried to act to make everyone whole in these negative situations with landlords. But out of the $46.5 billion that was supposed to go out, as of late last week, only $3 billion had gone out. So it's really a bit of a mismanagement issue politically and in terms of spending money that Congress had allocated, much more than an ideological issue that I can tell.
Jack, I of course don't have a particular view on this. The unemployment insurance expires in September. I'm just wondering from your perspective, if there is a conversation brewing here about delivering more assistance once that does expire in September, given what's about to happen with evictions.
Well, the timing and the back and forth on the eviction issue makes you wonder, because the administration had initially said it would let it expire and then at the very last minute asked Congress to act. So that may not be a good sign for them standing by their exact plans. But the president has pointed out, and people around him have publicly pointed out, this is set to end in September. They plan to let it end. That kind of relieves some of the partisan debate that's gone on back and forth for months in Washington over what exactly the role of those benefits are in terms of the slow return of the workforce. So we haven't gotten anything specific showing that the president might change his mind on that. And I think the general expectation is that is going to end in September.
Meanwhile, we have the infrastructure debate ongoing with Lindsey Graham, the senator from South Carolina, being diagnosed with coronavirus, not able to join for the vote for 10 days as he isolates himself. He has been vaccinated. He is okay. That according to the reports, but he doesn't want to infect others. There is a question of how much flexibility there is, how much support there is with enough of the constituents to get this bill across the finish line before the recess. What's the odds, from your perspective, from the people you speak to, that they'll be able to plow forward regardless of Lindsey Graham's participation or not?
Right now, it's looking pretty good, but you do deal with narrow margins in the Senate. I'd point out the first procedural vote they took, they needed 60 votes, and they'll need 60 votes again, but they got 67 votes. I think the amendments upcoming will play a significant role. I looked through all the amendments filed as of yesterday. None of them were really controversial. At this point, they're taking votes on an untold number of bipartisan amendments that don't seem to threaten that many votes. But as you go through that process, somebody could get upset over something and you lose votes. But the fact that the starting point is essentially 67 and they need 60 is a pretty good sign, especially given that we haven't heard of anyone else testing positive. There was a party or a gathering, they said, on a houseboat. The more negative tests that come back from that, the better for them, because if a dozen people are affected, that's obviously a much different scenario. But as of right now, this kind of takes them down from 67 to 66, which doesn't look like a problem.
Jack, thank you. Jack Fitzpatrick, Bloomberg government reporter down in Washington, D.C. Tom, you're right to point out what's about to happen with evictions. We've gone through the numbers a couple of times. I'll do it again because I think it's worth it. This, according to the latest Census Bureau survey. Now this has expired. This is what's at risk. An estimated 3.6 million households who've fallen behind on their payments are somewhat or very likely to face eviction over the next 2 months. About 7.4 million households are behind on rent in total. Tom, this all according to the latest Census Bureau survey, and those numbers are just horrendous.
Whatever your politics, the inability to distribute the funds shows a level of distrust in the process. And John, it's not just evictions, it's the underlying landlords that are hammered by certain bills. And even above them, some of these smaller banks, they're not JP Morgan. They can't do it out of petty cash.
If there's a debt, Tom, there's someone not paying and there's someone not being paid. And Lisa, that's the situation right now.
The interesting thing is also where a lot of these evictions may occur. And you can actually see that it's concentrated in southern states, in particular Mississippi, South Carolina, and Georgia, where they are more likely, tenants are more likely to carry rent debt in the U.S. on average. Just looking at this, you wonder what the political ramifications are as well of those images of people being kicked out of their homes, John.
Yeah, a story that we need to stay on top of right here on Bloomberg Surveillance, on TV, on radio, alongside Tom Keene and Lisa Brownwood. I'm Jonathan Ferro. Up 14 on the S&P 500, advancing 1/3 of 1%. Yields are higher this morning by a basis point and change to 119.21 on a US 10-year. And euro dollar stronger, positive 0.2%. Euro dollar 118.92. From New York City this morning, good morning. This is Bloomberg.
assess the sector as a whole? Is it making a better case for itself at the right price at this point?
Most of the big hedge funds, most of the people that have been growing, have been delivering very good performance. We have, but so is a number of the peers. You know, it is definitely the hedge fund business is getting more about the large getting larger and generating more performance, being able to hire the best people, thereby generating better performance, thereby getting larger. So when you look at the performance of the largest, say, 20 or 50 hedge funds, the performance has been pretty good over a number of years, and the inflows have been pretty good. You know, this is another quarter of positive inflows for us. I think one of the bits you're seeing at the moment is every client is worried about inflation. When they say they're worried about inflation, what they really mean is, I own a load of bonds, is that going to cause me a problem?
I assume you have a lot of people saying the food isn't as healthy as they might want it to be. Is that the biggest challenge, or just growing the company?
Ray Kroc had a famous line, if you're not green and growing, you're red and rotten.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Live from New York City for our audience worldwide on TV and radio. It's the price action this Tuesday morning on the equity market. Futures positive by 1/3 on the S&P, on the Nasdaq up by a little more than 1/10%, and some nice outperformance on a Russell of small caps up by 0.7%. Coming into August with a broken consensus and a wide range of views. We've had a few of them on this program already. We've had John Stolfus of Oppenheimer looking for 4,700 on the S&P and 3,850 the view from Anahan and Chris Harvey over at Wells Fargo. A wide range of views on the equity market into year end and on the bond market too. Switch up the board, 2s, 10s, 30s. Your 10-year yield right now at 118.88. You've got Steve Major at HSBC looking for that move, that relentless move, gravity almost, pushing us back to 1%, pulling us down on a 10-year yield. Then the likes of Morgan Stanley and others looking for a move back to 160 and beyond. That range of views extends from the Southside strategists all the way to the FOMC and the Federal Reserve and the Board of Governors itself. Two very different views on what to do next. Switch up the board. You've got the view from Governor Brainerd, patience, the view from Governor Waller and President Bullard, almost said Governor Bullard then, maybe the same person. They are two very different views. Here's the view of the market right now. Financial conditions, loose, loose, loose. This from Mohamed Al-Arian in the last 24 hours. And I think the Goldman Sachs Financial Conditions Index is one the Fed has got to be looking at, Tom. Financial conditions. When this chart goes lower, that means conditions are getting looser. And that is record looseness for financial conditions in this economy, in this country.
Overnight repos, John, went back under $1 trillion yesterday, but it's something to watch. You know, there's a gloom crowd, a fear crowd talking about $2 trillion overnight repos. And I don't know if you get to that number, but the answer is the financial conditions are something we've never perceived
How much support does this market need in the environment we're in right now? And the likes of Governor Waller, the likes of President Bullard, Bostic, Kaplan,
They're going to
others.
wait for the data.
Tom, they've already seen the data. As far as they're concerned, we're not an emergency anymore. This is loose enough. The work is done. Let's move on. Let's get the ball rolling. We need some optionality for 22. I'm with you, Tom. Others disagree. I mean, what did Joe Lavorna of Natixis say earlier this morning? No hike through 24. No hike through 24.
Okay, that's an
Compare and
outlier.
contrast that with Stephen Stanley of Amherst Pierpont, who's looking for a hike next year of June 22. And I started this conversation, Tom, by saying no consensus one and a wide range of views. That's where we're at right now.
Yeah, okay. When do we get the dots redone? I mean, they're going to be as silly as they are. Yeah, you know, next time around.
Looking forward to the coverage, Tom. I can see you're excited too. Just to get through August. Let's get you some
I want to
stock
see
movers.
the data.
Here's Romain Bostic with your moves this morning. Hey, Romain.
Hey, good morning, guys. Let's start off here with Alibaba. We did get earnings out of the company. A lot of folks, of course, were focused on the company because of the regulatory overhang here. At least right now, in the short term, there doesn't appear to be a huge impact. You're talking about a company with $32 billion US dollars in quarterly revenue here, and a company that still seems to be investing in its business longer term here. So whatever regulatory crackdown is going on over there on Alibaba, on Ant Group, and the rest of the Chinese tech sector, at least for this particular company, it doesn't seem to be upending its longer-term plans. Nevertheless, the shares down fractionally here on the morning. They've been oscillating between gains and losses, now down about 0.5%. Eli Lilly taking it a little bit harder. They did come out with earnings. Those shares down about 2%. Mainly this has to do with that COVID therapy. Remember, sales in the most recent quarter dropped down to about 150 million. That's down from 800 plus million in the most recent quarter prior to that. Now a lot of focus is going to be on the company's Alzheimer's treatment, which of course is still in development. This is still a juggernaut of a company. You're talking about 27 billion in annual revenue projected for the most recent year ahead here. But again, that's still a little bit light from what the street was expecting. Also coming in light here is Clorox. They reported earnings. These shares down 8.5%. This is a company that really got hit hard. Remember, they benefited a lot from everybody disinfecting and doing everything during the pandemic. Sales came in way below estimates, and they're projecting a 2 to 6% decline in full year organic sales here. This is for the fiscal year that just started in July. So this is a big deal. Keep an eye on that. Also keep an eye on Take-Two and the rest of the video game space. Last night, Take-Two did report earnings. They also missed estimates both in terms of revenue as well as in their monthly active users. This is a stock also that the company that basically came out and said they're delaying a couple of games. They didn't specify what those games are, but the shares, I know this is going to be big in the Keen household, I'm sure. Down 4% here. Activision Blizzard reports after the bell tonight, Tom. Keep an eye on that. And of course, a lot of concerns here about Tencent and whatever the heck's going on China and those reports about the video game industry there. Finally, Tom, keep an eye on Lyft. That's reporting after the bell tonight here. This is still going to be a money-losing company, so don't expect any profitability.
Romain, seriously, are they going to talk about vaccinated, unvaccinated drivers? Is that on your radar for the close?
Well, they're going to talk about it, but here's what they're also going to talk about. Here's the deal, Tom. You're talking about a company that, despite the fact that they're losing money, despite all of the concerns, they're going to punch through 700 million in shares. For the first time, Tom, they're going to have something like 15 million active monthly riders, however they measure that. And more importantly, Tom, they're talking about $45 per active rider. That's a big deal for this company that, of course, was below 40 just a couple of quarters ago. So they're getting more money out of their riders. So I guess that's a good thing. That means either we're riding more or riding further, or maybe the prices are higher. Who knows? But there's a lot here going on with Lyft. I tell you, most of the folks over at Bloomberg Intelligence who cover this, Mandeep Singh and that whole crew down there, they're pretty bullish on both Lyft and Uber with regards to ride-hailing, that ride-hailing business.
Romain Bostic, thank you so much to close this afternoon here in earnings season. This is an important conversation, and it may surprise you that it's our conversation of the day. We're trying to recalibrate equities and economics into the litmus paper of the system, which is yield. And John Farrow, you've talked about global yields as being as important in their interdependencies as the U.S. 10-year benchmark.
Yeah, let's get to Parag Garvey on that, Tom. ING head of global debt and rate strategy. Parag, all this talk about 10-year yields and they shouldn't be down here in the Treasury market. Then you look to Germany, and yesterday the whole curve below zero, beneath zero. Parag, how important is that dynamic, the European dynamic, that gravitational pull, yield to lower?
Oh, it's absolutely vital. It's I mean, this is an incredible set of circumstances, but you can't get away from the fact that the Treasury yield is the global benchmark. And as we sit here today, we're looking at that 10-year heading towards 1%. And I think the big lesson here for Europe is that Europe never really recovered from the global financial crisis as measured by monetary policy. I mean, rates are still negative. QE is as aggressive as it's ever been. The only hope for Europe is that the US manages to repeat what it did post the great financial crisis, stop buying government bonds, raise rates, get back to some semblance of normality. So what I see in Europe is a loss of hope, because if the US can't do it, how can the Europeans do it? They haven't done it before.
A loss of hope. I mean, is that the message from the $16.5 trillion of negative yielding debt, the highest volume globally since February? Is this representing a loss of hope?
You know what, you've got to break this out as to whether the market discount is telling us something about the future, or whether the market is being pushed there by an excess demand for fixed income. And I think it's a bit of both. In a sense, there is a loss of hope because we've got to accept that the marketplace, the bond market, is a discount function. But at the same time, we know central banks are huge buyers of government bonds, persistent buyers of government bonds, and that's a major catalyst behind this fall in yields. Everybody wants to be on the same side as the central bank. And as long as central banks are buying bonds, that's the side you want to be on. Hence, we find ourselves in this incredible situation, very deviant from where macro circumstances are.
Mark, you know, we're all talking yield here, but this is a time where I flipped a price, and the answer is there's a massive bid on all this paper. Is it similar to 2005 and 2006, or is there a different character to the bid, the insatiable desire to move price up on fixed income?
There's a whole series of players out there, Tom, that are buying fixed income. And, you know, it's not just guys buying bonds. It's also corporates setting up fixed rate receivers where they swap from paying fixed to paying floating because they feel that by paying floating, they're going to get the cheapest funding, and the prognosis in terms of rate hike risk is really quite dim. So what I see is an excessive demand for treasuries. We see a lot of buying out of Tokyo, for example. And, you know, I've said it before, if you're sitting in Tokyo, you don't care what U.S. inflation is as long as it's not affecting U.S. yields. And that's the story. I mean, if the simplest explanation for where we are is an excess of demand of supply for fixed income. But it poses problems. The Fed have not spoken about this, but they will not be happy to see the 10-year approaching 1%. It makes life very difficult for them.
They should stop buying tips then, shouldn't they, Porrick? And we'd stop talking about real yields, wouldn't we? Wouldn't we have an adjustment there? I mean, I'm asking you the question how distorted that market is right now.
Well, the entire spectrum of rates is distorted. I mean, minus 100 basis points is an absolute distortion. 1% potentially for the 10-year is a distortion. And here's the thing, the Fed wants to hike rates. Not now, but they will want to hike rates. You can't hike rates with the 10-year at 1% because you're just going to invert the curve.
Yeah.
So they have an issue. They want to get that 10-year up to 2% ideally. The way to do that here and now is don't taper, just stop buying government bonds. Will they do that? Unlikely, but that's what they probably should do.
Porrick Garvey, it's good to catch up. ING Head of Global Debt and Rate Strategy. TK, this is the issue right now. You can say it's distortions and technicals, but eventually they become fundamental narratives. Price shapes narrative, and then this story, this theory of reflexivity starts to emerge. It's a market that shapes the weather it anticipates in many ways, Tom, and this is an issue, I think, for the bond market going forward from here.
We could get philosophical here, folks. Reflexivity is owned by George Soros back to Karl Popper, and John, you're absolutely dead on in that it is an ex-post central bank. And then what Popper weaned in the early 1950s and George Soros picked up on is the narrative changes, and that changes your interpretation to the ex-post view. I hope I got through that in one piece.
Porrick just said it for us. Yeah. This Federal Reserve, even if that bond market move is just full of distortions and technicals, it could stop them from hiking interest rates because they don't want to hike interest rates if they're going to invert the curve.
On radio and TV, I can only say it is just an honor to deal with John Farrow on economic epistemology, the British way, and reflexivity.
Thank you, Tom. I'm not sure how authentic or genuine that was. Tom Keene, Lisa Bramwitz, Jonathan Farrow. Equity futures at 15 up a third. Mistraining again. He's missing. The Italians say he's found in Giorgio Chiellini's pocket. I'll leave that there. From New York, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden and top White House officials are trying to stave off a wave of evictions. A federal moratorium on evictions just expired, and the president is pressing federal, state, and local government agencies to act quickly to stop tenants from losing their homes. The chair of the Securities and Exchange Commission is preparing more oversight of cryptocurrencies to protect investors. Gary Gensler has unusual expertise in digital assets, but in an interview with Bloomberg, he signaled that he's not on board with the hands-off oversight approach that many enthusiasts would like to see. He says that investors must be protected against fraud. Standard Chartered overcame economic headwinds across Asia to beat second quarter forecasts. That's allowing the bank to buy back shares and plan a small dividend. We spoke to CEO Bill Winters in an exclusive interview.
We'll then have plenty of capital to continue to invest either organically or inorganically. So if we get some interesting acquisition opportunities along the way, we'll have the capital to do that. If it turns out that there's nothing out there for us to invest in, which would be a bit disappointing, then of course we could resume buybacks or increase the dividend.
And Standard Chartered is expecting full-year income to be in line with what it was last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
We can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature, it is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Some of the best deals in history have been passed on by a very large number of people. The money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
For the people here on Earth who are wondering why are we investing all this money in space, this time in space, talk to us about how you believe this will actually help benefit us here on Earth.
We're building infrastructure. This is a road. We're building a road to space so that future generations can build the future. We live on this beautiful planet. It's the most beautiful planet in the solar system by far.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
As of Saturday, CDC reported the 7-day moving average of daily new COVID-19 cases to be about 72,000 cases per day. This represents an increase of 44% from the prior 7-day average and higher than our peak of last summer.
Rochelle Walensky there, the CDC director. The important component, of course, the relationship and the change relationship between those cases, hospitalizations, and ultimately deaths. We can talk about that in just a moment. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's your market up 16 on the S&P, advancing 0.4%. Yields are higher by about a basis point. 1 basis point higher to 118.71 on 10s after yields broke down through the best part of yesterday's session, the latter part of yesterday's session. One name to watch in the pre-market, Lilly down mildly. It's a mild move lower by about 1.67%, Tom. I'll just rattle through the numbers, Tom, and give you the forward look as well. Second quarter adjusted EPS at 187, the estimate 189. Second quarter revenue 674, 6.74 billion, the estimate 661. Just a forward look here on revenue, Tom. Full year revenue 26.8 billion to 27.4 billion. Had seen 26.6 to 27.6. So no big moves in the mix here, Tom. Just a subtle move lower, down by 1.67%.
This is a joy, and it is a joy, John, when you are weaned out of Indiana, as part of my family was. David Ricks is with Eli Lilly, their chairman, their chief executive officer, celebrating his 25th year with the company. The Ricks era, going back to his first day darkening the door, is 12% per year. In the last 10 years, the stock is Home Depot and Apple-like, up 24% per year. It has been an extraordinary move. David Ricks, I want to talk about where you are now with COVID. There's some sensitivities here with the antibodies and that. When you're meeting with your head of research and science, Daniel Skowronski, as well, when you look back at the last 18 months on COVID and you look forward to the next 18 months with this horrific pandemic, what have you learned, and what's the to-do right now for Eli Lilly in this horrific pandemic?
Yeah, Tom, thanks for having me on, and Dan's a key partner for us. And as a science-driven company, you know, those meetings happen a lot, as we were talking offline. COVID, we've had a lot of ups and downs with COVID. You know, last year, we had a lot of unknowns about how this would progress. And we set to work to create therapies, because that's what we do. We're not a vaccine company, that could be helpful. And we did that. I think we're very proud of that. We launched neutralizing antibodies, both a single and then a combo. We also have developed one of our anti-inflammatory medications, Olumiant or baricitinib, which actually today we read out results that in those on ventilation or ECMO, the most advanced patients in the hospital, reduced death by over 40%. But we just wanted to, you know, put our tools to work to be helpful. You know, our ongoing business is about treating other diseases. We're not a virology company. And so as the pandemic has ebbed and waned, those businesses have come back strongly as treatment for diabetes and cancer has improved once doctors' offices open. You know, we don't think about ourselves as a COVID company, but we were happy to make a big contribution. And this year, you know, that ended up in a fair amount of sales. Although in the second half, you mentioned the guidance being narrowed on the year. That's really about reducing COVID-related antibody sales and increasing the performance of our underlying business. We do expect that as these waves happen, they'll begin to subside. Each one will be lower, and a new sense of normalcy will set in. Right now, we have a problem in the U.S., but you know, we think there's a way to fix it. Get everyone vaccinated.
David Ricks, tell me about Alzheimer's. The absolute uproar in Washington about the need for a solution, the whole FDA thing. I get that, fine. You guys going back to insulin, get these horrific diseases correct. What are you going to do to help our listeners and viewers with Alzheimer's?
Yeah, thanks. This is an area that's very personal to many of us at Lilly, and our scientists have been working for over 30 years to try to create a medicine that could slow the progression of this disease. You may know this, but it's the 6th leading killer. It's a fatal disease, and it's the only one in the top 10 without a medication that slows it down. Recently, the FDA shifted their policy. They said, look, showing an ultimate benefit in a slow-moving, difficult disease that we don't fully understand has been hard to approve drugs on, but they
Excuse
moved
me for
along.
interrupting. This is really important, Mr. Ricks.
Yeah.
Do you support that shift in FDA policy?
So, look, the regulator needs to make that decision about risk and benefit, but of course, we believe that amyloid reduction leads to slowing of the disease. We've been betting on that for some time and put billions behind it in research, and now we have a leading product in that area, donanemab, which had the first ever clinical trial in humans read out positive in Q1.
Dave.
So we have launched a bigger study, and we said in Q2, we're planning to submit this year under that new policy. And we think patients deserve access to that medication, but we're going to prove its worth just in the following year. We have a huge study going on that we just said is almost enrolled, and will prove that benefit.
Dave, the Biogen drug was incredibly controversial when it came out, in large part because of its price, in addition to the FDA policy, which did seem controversial even within the FDA panel. How do you plan to be different with your Alzheimer's drug in terms of the controversy, in terms of the pushback, and frankly, in terms of the price point?
Well, we're not going to announce the pricing today, but I'll just point out, I mean, we tend to compete aggressively in all the markets we're in, and that benefits patients. And we compete by creating better molecules, better medicines themselves with different properties. In this case, our medicine works very rapidly to clear plaques. By 1 year, almost the vast majority of patients in our study no longer needed to take the drug. They had cleared all the plaque in their brain. That's different from all the other antibodies being studied, which are really lifetime therapies. Secondly, we compete on data, and this is important here, and I think the source of the controversy. Few argue that the approved drug might have worth. I think the big argument is, did they prove they had worth? Did it really affect the disease? Of course, we are committed to complete the study that's now basically enrolled. We'll finish enrollment this quarter.
Yeah.
And we'll have that data in 23, which is pretty short period of time in the trajectory of drug development. And finally, we will compete on value in the marketplace. And when we hopefully get our approval sometime next year, we'll talk about our pricing strategy.
Dave, just quickly, a minute on the clock. Are you requiring your employees to be vaccinated?
Not at this time. We're not. We believe we have very high rates of vaccination in our population, but we're tracking that issue very closely. And of course, new information just released in the U.S. about the transmissibility of the Delta variant from those that are actually vaccinated is of concern. We're analyzing that as we look at our policy. To date, we've had very few, if not zero, in many of our facilities, transmission of the disease.
Yeah.
And so it hasn't been a real problem for us in running our business, but we want to look at that and stay abreast of the latest information.
Dave, it's good to catch up and get your view this morning. Dave Ricks, Eli Lilly Chairman and CEO. You as well, sir. From New York City this morning, good morning. Your equity market pushing higher by 0.4% on the S&P 500. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Heard on radio, seen on TV for our audience worldwide. This is Bloomberg Surveillance.
is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
An exceptional Q2. It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Once the market really starts to doubt the potential for reflation, the potential for growth, that can kind of spiral out of control.
There's always pullbacks, and mini corrections, maybe even a correction ahead.
The market kind of has this view right now that if the Fed starts hiking, they will not be able to get many rate hikes actually done.
I would argue the labor market is as tight, if not tighter, than any we've seen in decades.
I'm more worried about growth in 2022, and that's what the U.S. bond market and global bond markets are sensing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It's a simulcast, a Tuesday simulcast, radio and television. A steam guest coming up, particularly equity market. We really looked a lot at the stock market today. And John Stolfus got us going. I mean, John, take it out. 4,700 on to 5,000. That's a Dow 39,000 equivalent.
Thanks, Tom. I'm sure they've got a Dow year-end price target over at Oppenheimer too. Not. Your equity market up 16 on the S&P, up 0.4%. In the bond market, TK, you and I, Lisa too, we've been talking about this broken consensus in the bond market. It's in pieces after July and a 25 basis point move lower on the 10-year. And I wonder, Tom, to what degree, to what extent a consensus remains on the Federal Reserve as well, and whether Chairman Powell is really struggling here to reflect one that may not exist.
Okay, that may be true in economics, John, but take it back to Fibonacci 101. If the yield is telling us something and the bid up in bonds is telling us something, you flip the reciprocal, and that's how you get the Dow 40,000.
What is it telling us? Away from the Dow talk, what is it telling us? Can we agree on what it tells us? Does it tell us that the Federal Reserve has a massive presence in this market? That they hold 25% of the TIPS market? Does it tell us that the hopes for better growth through Q1 have basically been diminished by the fears of decelerating growth through the year ahead and into 22? I have no idea. You pick 5 strategists, I'll get 5 different reasons as to what's going on.
And somebody on the Zeitgeist mentioned the 10-year in Japan didn't trade yesterday. Lisa Abramowitz, your thoughts on all this, and bring it in away from full faith and credit bonds into what you're observing in IG and in high yield.
Basically, the Fed's put that has been ongoing, as Bill Dudley even said, was the main dominant factor in yields being as low as they are, is trickling over to the credit side, companies refinancing at the fastest pace ever. I think we were really framing the debate well, both you and John, earlier today when you were talking about, can the Fed raise rates and move away from their stimulus? If everybody is buying into it and following them, how disruptive, Tom, will it be for them to change course? If everyone is just saying, we don't want to fight you, we're on the same page with you, and that will necessarily lead to a correction that perhaps the Fed's not prepared for right now.
John, do we change the parlor game over the Fed when we see a headline that Tyson Foods will require vaccinations from the U.S. workforce? I'm sorry, that filters into our game.
Let's frame it broadly, then we'll get specific.
Sure.
We've talked about August as the path through to September. Why? Because September, we're waiting for this supply-side response, more people coming back to work, easing some of these supply constraints. That's why how we respond to this COVID variant, the Delta variant in the coming month, is so important, and that's why this headline matters more specifically to the likes of Tyson Foods, Tom. So let's rattle through them together. They're going to require COVID-19 vaccinations for the U.S. workforce. Almost half of the U.S. workforce has been vaccinated. Infection rates among team members remain low, and they've given a date, Tom. All team members required to be vaccinated by November 1st.
Okay, so
worth pointing out a couple of things: the size of the workforce and the nature of the business. 139,000. It's a big workforce, Tom. The nature of the business, when you think about that, I think this decision speaks for itself.
November 3rd, also a Fed meeting. Maybe that's a small coincidence as well. John, let's get through the data to get to our important guests. The VIX 18.70, futures up 16. Equity markets giving me a lift, maybe small cap doing better.
Yields 118 on a 10-year, Tom, basically unchanged. They were higher by a basis point or two. We're now going nowhere. Talked a little bit about foreign exchange already this morning, Tom. If you tell me how this market responds to the data in the bond market, I'll still have difficulty telling you how the FX market will respond to the bond market. So there you go. It's a challenge for anyone operating in financial markets at the moment, except for those that just said, you know what, start of the year, I'm going to buy an index, the S&P, the NASDAQ, and I'm going to sit there and do nothing for the year. And then let these conversations go along around me. And the Dow, if you want to as well, Lisa. I imagine there are some products out there.
There are a few
that you can buy to get exposure to the Dow index if you want to.
How generous, charitable.
All right?
Yeah, very good. Joining us now on the Dow Jones Industrial Average, Michael Holland with Holland and Company and their chairman, knowing that the Standard & Poor's 500 is more indicative of what's going on. Michael Holland, I want to ask you a Louis Rukeyser question, and I say this with great respect to the sweat of Wall Street Week years and years ago when fear was ascendant. The way we solve fear in our equity ownership is to extrapolate out what successful companies do. How far out are you extrapolating right now on the companies you believe in? Are you out 6 months? Are you out 6 years?
More like the years than the months, Tom, but I think there are fewer and fewer companies that one can zero in on and say, I think this is worth the risk of losing money because the potential for the upside is so significant. There is enough cacophony around about the economy, the Fed, China, COVID, and on, that companies like Tyson, which you were just talking about, are indicating the world continues to change under our feet. Yet in the markets, because of the tsunami of cash that has come over the markets over the past few years, we have pricing that we've lost price discovery. We've lost real rates of return to use, risk-free rates of return to use for econometric modeling. So the Fed is flying as blind as the rest of us.
Interesting to me, Michael, how willing investors seem to be just to isolate a problem. A problem emerges, they can put it over there to one side and say it won't bother us too much. And a great example of this, you mentioned China. This is what Dan Ives of Wedbush had to say. My producer Jamie pinged this across to me in the last couple of minutes. This is what Dan Ives says. We believe these dynamics will yet again bode well for US tech stocks as the favorable backdrop and rotation away from Chinese tech into US tech creates a Nirvana setup. So, Mike, we used to say a couple of years ago, what hurts some would hurt everyone because we're all buying the same basket of goods. Now we've got people saying what hurts China will actually benefit US tech. Let's rotate even harder into them. What do you make of that dynamic?
The dynamic is reflective of a market that has gone inexorably upward, Jonathan, over the last several years. And I think looking for the positive outcome is something that I'm always prepared to do. But in the case of China, I think it would be a fool's errand to ignore what's going on. There was a wonderful piece in Bloomberg Intelligence yesterday on the terminal about the thing that's different about China today, in contrast to the last 40 years, and most of which I've spent going over there, is that they now remember that they're communists. And when they remember they're communists, you end up with a situation where you're not doing things as they've been doing for the last, which created Alibaba, which created the opportunity for people to make tons of money. They're now becoming political and warrior-like.
So, Michael, fold that into an investment thesis. If price discovery has gone away, if we have China that matters more broadly, what are you doing right now?
Being very careful, and Lisa, and actually, we've kidded before about the all-weather portfolio, but I think the three of you opine daily, there are things that don't make a lot of sense, can't be explained in terms of where prices are. You have a 5% earnings yield, the flip of the reciprocal of the price earnings model on the markets in the U.S., and less than a 2% 10-year Treasury with inflation looking like it's going to be sticky at somewhere around 4 to 5 to 6, or maybe 2 to 3 to 4. But these things don't make sense. So what I do is try to identify properties that are useful. Tom asked a question about weeks and months, or Jonathan as well. You buy properties. I would say that companies like General Motors, which I've been looking at recently in the last several months, have a plethora of things that could go right, but a valuation that doesn't reflect the overall market. So the risk, but there are fewer of those. They're just, it's hard to do.
Michael Holland, do you do some of the parts analysis on companies that have different sections? They're not Ling Temco Vote. Michael, you and I are the only ones listening or watching that know what LTV is. But if they're not Ling Temco Vote, do you still do some of the parts, say, on Amazon, Apple, or some stock I don't know?
Yeah, absolutely, Tom. It's interesting that you even have to ask the question, because that's what value is. If the three of us, the four of us, I should say, we're looking at something to buy in the private market, we'd look at what is it worth? What are we willing to pay for it? And in the public market, people have gone away from doing just what you described. Jimmy Ling and the LTV crowd figured that out a long time ago. But prices were so low back then in a lot of cases that you could find out that if you looked at, let's use General Motors today. If you looked at the different kinds of businesses there in technology, any individual one of those a few years from now could be worth a gazillion amount of money. But they're trying to do that to further the businesses. But yes, you do still have companies like General Motors that afford that opportunity to look at maybe some of the parts is really worth a lot more than what the market's paying for them. But not too many of them anymore.
Mike, you're a legend, and it's always great to catch up. We appreciate your time. Michael Holland there, Holland & Co. Chairman. Let's reiterate that headline of the last 10 minutes. Here's a company that's not bothered by the politics. It's looking at the science, and it's made a business decision. It's Tyson Foods to require COVID-19 vaccinations for its U.S. workforce. The problem we have right now, Tom, tons of demand, supply problems, worker absenteeism. And a company like Tyson Foods is looking through winter and wondering what happens to their production capacity, what happens to their ability to make sure they've got the adequate supply of workers in the business, Tom. And this is how they're trying to tackle the issue.
And there's a southern cast to this out of Springdale, Arkansas, that will be part of this analysis to their November 3rd date.
Providing $200 to fully vaccinated frontline team.
There you go.
There you go. Up a third of 1% on the S&P this morning. From New York City. Good morning.
1,000.
Alongside Tom Keene. Lisa Abramowitz wants it to be 1K.
No, I didn't.
And
he
not
did.
$200. Tom said 1,000.
That's what he said
Are you
yesterday.
correct in TK?
Well, he was saying 200.
Are you keeping notes?
Yes.
Future's positive. This is Bloomberg.
With
the First Word News, I'm Ritika Gupta. The surge in COVID cases is increasing pressure on U.S. drug regulators to fully approve the Pfizer coronavirus vaccine. It was the first one to apply for the full licensure in the country. Approval could help the Biden administration ramp back up its immunization drive and reassure vaccine holdouts that the shots are safe. Alibaba posted quarterly revenue that missed estimates, that's suggesting plans to hike spending in pursuit of growth have yet to gain traction. Meanwhile, the Chinese e-commerce giant said it was increasing its share buyback program by 50%. That's to $15 billion. PepsiCo will sell its Tropicana juice brand to a private equity fund. PAI Partners will pay $3.3 billion for Tropicana, Naked Juice, and other juice brands. PepsiCo will retain a 39% stake in the new joint venture. Juice sales have been under pressure because consumers are cutting back on sugar consumptions. And at the Tokyo Olympics, American gymnastics star Simone Biles made an emotional return to competition and won the bronze medal in the balance beam final. That came just a week after she withdrew from several events to focus on her mental health. The bronze was Biles' 7th career Olympic medal. She won it by drilling a slightly watered-down version of her usual routine on the beam. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
If inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
I assume you have a lot of people saying the food isn't as healthy as they might want it to be. Is that the biggest challenge, or just growing the company?
Ray Kroc had a famous line, if you're not green and growing, you're red and rotten.
How are you navigating what seems to be a really tough situation better than almost anyone else?
We've worked hard on the supply chain. There's no question there's a lot of work to do in the supply chain for semiconductors. And we're happy that we were able to exceed our second quarter guidance, as well as, guide up for the rest of the year.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
It takes markets a long time to realize that something really fundamental has changed. Right now, I think you are seeing, not just inflation data, but you are seeing inflation present in virtually every corporate earnings call that you hear about.
That was Michael Schau there of Marketfield Asset Management, the CEO. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market picture looks like this on the S&P 500 this Tuesday morning. We advanced 12 on the S&P, up a third of 1%. On a 10-year, yields unchanged at 118.05. And some updates for you. Tyson Foods coming out and requiring its staff to get vaccinated by November 1st. The McDonald's, Lisa, in just the last minute or so, they're pushing forward as well.
Yeah, they're saying that all customers and staff will need to start wearing masks again, mandatory masks inside its U.S. restaurants and in areas specifically with higher substantial transmission of the Delta variant of COVID-19. But it just shows, John, how the private sector very much leading the way when it comes to tightening protocol going forward with this pandemic.
Those decisions coming in the last 24 hours, just unbelievable to start to see corporations respond to this through last week and into this week as well. One name to look at related to this pandemic, Clorox at a pre-market down by more than 11%. I'll rattle through the numbers for you. See second quarter, or rather the year ahead, see sales 2 to 6% decrease. 2022 organic sales down 2% to 6%. Tom, it goes on, adjusted EPS $5.40 to $5.70, the estimate $7.60. It's a miss as well on net sales at $1.8 billion, the estimate $1.9. Adjusted EPS coming in at 78 cents versus $2.41. $2.41. And it's pretty clear what's going on here, Tom. Monster pull forward last year. People have still got this stuff in the cupboards. And as Lisa and I both said in the commercial break, this is the end of hygiene theatre in a big way for many people. They're stocked down by 11%.
Yeah, 8 standard deviation move, really, in the churn that it's been in recently, it's a huge move. John, it's round trip. It's really pretty much back to where it was Valentine's Day of 2020. I mean, you wonder, are we going to see more of these?
Down 11%, Tom. Yeah, we're down to, where are we? 161.23.
Well, we will see. So there's the stories of the stocks today, and of course, all of this very much moving. Part of it moving is a technical nature of what we see in the equity markets. Jonathan Krinsky with us now with Baycrest Partners. I'll get it out. Jonathan, I love your note because you go back and you say, look, small caps, I miss that. You look at large caps and you fall in the center. What's the value of what nobody's talking about right now, which are the stocks in the mid-cap space versus the juggernauts of the world, or all the fever over small caps?
Yeah, there's this ongoing battle between small caps and mega cap tech, and you can see it even on an intraday basis where off the opening bell, small caps will rally, mega cap tech will sell off, and then it'll flip on a dime and just completely reverse. And that battle can be seen, on the intraday charts and on the daily charts as well. But yeah, I think the mid caps are an interesting group here because they don't get a lot of attention as far as the index itself, the S&P 400, but it's been doing a bit better than the small caps, and it's a bit further along in its upside breakout. So we think, take your eyes off the small and large and look right there in the middle. There's some really good opportunities.
Jonathan, what does the technical strategy of melt up again, and melt up yet again look like? I mean, I'm looking right now at a Bank of America metric, basically saying that there is almost a contrarian sell signal based on how many people are bullish, and then even more bullish because what could potentially end this rally?
Yeah, well, that's what happens when you don't have a 5% pullback in the S&P for, I think we're going on 9 or 10 months now. And that's really the paradox of the market, right? Because on the one hand, we know that, markets tend to get at least a 5% drawdown almost every year. So, the clock is ticking there. On the other hand, in markets, when you go this long without that 5% drawdown, it tends to persist, right? We saw the entirety of 2017 go without a 5% drawdown. So we're really in this battle here, and we kind of use the analogy bull in a china shop for the current market, because it is a bull market for the S&P anyway. And long-term breadth is pretty good. If you're looking at metrics like percentage of stocks above the long-term 200-day moving averages, those metrics are still really good. But we know there's this violence going on, in these rotations under the hood and on the sector level. We saw it in Chinese equities recently. Chinese internet stocks lost 55% off the top. So it's a bull market, but there's a lot of violence going on under the hood. And, we're not going to get that 5% drawdown until you see a sustained move in all the sectors, right? So we've just kind of had this push-pull where one sector will pull down, but then it'll be insulated by another sector rallying. So, I don't know what's going to cause all the sectors to kind of move down together, but that's really what you need to see that bigger drawdown.
So just to clarify this, in a recent JP Morgan survey, almost 2/3 of clients said they plan to add to stock holdings in the coming weeks. Bulls are getting more bullish in a way that we haven't seen, as we were talking about earlier. Are you basically saying that is not necessarily indicative of complacency because of the violence under the index level, that anyone who's talking about the melt up really is ignoring some sort of distinction between stocks, between sectors?
Yeah, I think there is a bit of complacency on the passive side, right? I mean, if you've just been in the S&P 500 and the NASDAQ 100, some of those passive strategies, that I think certainly some complacency is setting in, because again, we haven't seen any real pain to the downside since last October. But I think for the average investor or institutional investor that's got a lot of different stocks, maybe different market caps, there is more of that pain, and there is more of that caution. So it's almost a tale of two markets. But I think as we get, we know we've talked about all the bearish seasonals in August. We have a lot of Fed talk coming up with the Jackson Hole meeting. So I think the risk that a bigger broad market shakeout later this year is certainly increasing. And I think some of that complacency you talked about comes into this. So, again, we'll see. I think really, again, the S&P 500 is so dominated by mega cap tech that you really need to see, those FANG stocks come under some pressure. And to do that, you probably need to see interest rates move, kind of scare people back to the upside again, which we haven't seen in quite a few months.
Jonathan, we got to run. It's got to catch up. Jonathan Krinsky there of Baycrest Partners, looking at the bond market and rates. 2s, 10s, a break of 100 basis points again, back down to 99, a 99 handle on that 2s, 10s spread. That curve's flatter, Tom.
In the blur, John, I couldn't figure out the Japan 10-year story. Robin Wigglesworth over at the FT notes. It's Stephen Spratt of our Bloomberg noting no trading today in the Japan 10-year. John, I don't know what to make of that. I mean...
Well, that's what happens when a central bank consumes the market.
Exactly.
And that's what's been happening in Japan. And that headline's not the first time we've seen it, is it?
Yes.
We've seen it a number of times, Lisa. These markets... Can we even call them markets anymore in the traditional sense?
Just going to say the same thing. Is it a market if you have one behemoth in there just sticking its thumb on everything?
On everything. Price-insensitive buyer, sucking it all up. What does the 10-year tell you?
Who knows?
117.55. I mean, the answer at the moment is who knows. Got no idea. Your 10-year unchanged at 117.55. 2s, 10s breaking down sub 100 at 99 basis points. From New York City, Tom Keene, Lisa Bravitz, Jonathan Ferro. For our audience worldwide on radio, on TV, this is Bloomberg Surveillance.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July Jobs Report, Friday on Bloomberg Television and Radio. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lines in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Live from New York City for our audience worldwide. Good morning to you all on TV, on radio. This is Bloomberg Surveillance alongside Tom Keene and Elisa Abramowitz. I'm Jonathan Ferro. This Tuesday, here's the price action in your equity market. The S&P 500 pushing higher by around about 6 points, up a little more than 0.1%. Off session highs on the S&P. The Nasdaq 100 also up 15, call it 16 points higher, positive 0.1%. Outside of that, bond yields unchanged on 10s at 117.39. It's a shift higher by about half a basis point on the front end on the 2-year, and a shift lower on the 10-year, also by about a half a basis point. That's taking 2s, 10s down by a full basis point, which means, Tom, that gap, that spread is narrower to 99. It's just a really small move. Half a basis point on 2s higher, half a basis points on 10s lower, down a basis point on the curve to 99.
It is a splitting of hairs, but nevertheless, it's a benchmark. 100 basis points, a difference in yield of 1%, and to be beneath that is something I guess we'll look at. You know, the rest of the market may be churning and looking for ADP, and then claims, and then on to the jobs report. James Sweeney joins us now with Credit Suisse. Always 14 things to speak of. And to the chief economist at Credit Suisse, I must ask, James, how you formulate 1.1 million jobs on Friday. How do you derive that statistic?
It's a little difficult right now, but it's definitely causing us to put more attention on the non-seasonally adjusted than the seasonally adjusted number. There's some hints that some of these, what we call NSA numbers, have been a little more stable than the seasonally adjusted numbers. I don't know how exactly seasonal factors that include 2008 and 2020 in them are expected to work. So we think you lost a little bit of the jobs numbers from some of these adjustments a few months ago, and you're going to get them back this month.
James Sweeney, there's some mathiness here of the standard error. We're not going to go into it right now, but nevertheless, we observed the standard error of the April report on May 7. Do we have a same standard error exercise this time around?
I mean, I think it was bigger a few months ago. I think the data fog is starting to break, but it's not broken. So, I mean, in the initial return to work phase, it was particularly hard to forecast these numbers. It's still hard. It's not quite that hard. The most important variable, though, of course, is not payrolls in a given month with a big standard deviation, but what's the underlying average net jobs growth we're going to see over the next 12 to 18 months. And given that any individual month is so hard to forecast, you know, we also have to really think about where's the unemployment rate, where's the level of employment going to be in 12 to 18 months. And that's pretty difficult. I mean, if we're off by 500,000 jobs, you know, that could be the difference between getting a Fed hike or not in a given quarter. So economists are going to need a little bit of patience and sympathy, because we cannot really compare this cycle to previous cycles.
You're asking for patience and sympathy,
James.
Sympathy and patience. Tom, James Sweeney wants sympathy and patience from us.
He does, you know, he's a sensitive guy.
Are we going to give him some?
Yeah, absolutely. Yeah.
Good luck, James.
Let me ask you this question, James. Who do you think has the most support on the FOMC right now? Governor Brainerd or Governor Waller? Bit of disruption on the line, I think, there, James. I think you can hear me and then back through the microphone again. James, take a second. We'll re-establish that. I'll have some patience, a bit of sympathy, and we'll wait a couple of minutes. We'll come back to you. I think that's a key question right now. You've got the views of Governor Brainerd on the one side. Governor Waller coming out on CNBC yesterday with some views of his own. Governor Brainerd saying, let's wait for the September data. And then you've got the likes of Governor Waller, Lisa, who's basically turned around and said, if August is good, if the September numbers looking back through the month of August is good as well, going through September to that meeting, we're all go.
The margin of error is so difficult to get right now, especially when you get Stephen Stanley coming out and saying it's one of the tightest labor markets he's ever seen. And then you have the likes like Joe Lavorgna of Natixis coming out and saying that we're going into a very slow growth environment akin to what we've seen previously. How do you parse the difference between the diverse views here, John?
Supply side. How the supply side of this economy responds, critical. That's going to shape everybody's views, and September's really the starting point for that. And Tom, we mentioned Tyson Foods. I think Tyson Foods is a part of this story as well. They're trying to insulate the workforce from what they think could develop, maybe develop, going deeper into winter. Worker absenteeism, it's been a problem. We've got robust demand in this economy. We want to see supply start to meet it. And if we start to see an extra layer of restrictions, Tom, that keep people from coming back to the workforce, that's a problem. That's a big problem. You led earlier this morning with the participation rate in America.
Yeah.
That's what they're waiting for.
That's what they're waiting for, John. Thank you. And that was critical. And that was the core participation, not fossils like me, but cut and chiseled like Pharaoh, 25 to 54. And John, that's the heart of the matter. Yeah, it's improved, but it's nowhere near socially where it has to be for Chairman Powell.
So when Stephen Stanley of Amherst Pierpont, Lisa, says this labour market is tight, are we taking a view that that participation rate won't recover? Is that the view that underpins the call that this labour market is tight?
He was talking about some of the temporary factors keeping people out of the market, right? He was talking about the fact that people were concerned about childcare, having to be home. There were people concerned about the virus. And how much does that persist for a longer period of time, John? Perhaps we ought to be asking that, given the surge in Delta variants. But, you know, you ask a good question. We still don't really know the answer in terms of participation rate.
James, I'm hopeful that you have some sympathy and patience for our technical problems. James Sweeney, Credit Suisse Chief Economist. James, just to come back to you, the question I asked, who do you think's got the most support on the FOMC right now? The views of Governor Brainerd or the views of Governor Waller?
I think the views of Governor Brainerd right now, at least as we have not had an announcement yet on the new appointment. It would be interesting if Powell were reappointed in the next few months, if we'll see a slight shift because the doves weren't nipping on the heels so much. But I think right now, the language from the core of the committee, the governors in Washington, is pretty clear that they are not rushing to taper. I think it'd be very sensible to reduce the mortgage purchases as soon as possible, but that's not a signal they want to send out. And really, we're talking about tapering in Q4 versus Q1 at this point in this debate. It's not such a cosmic big deal at the moment. They're still many quarters away from an actual hike.
James, do you agree with Stephen Stanley that this is one of the tightest labor markets that you've ever seen?
I mean, I think labor supply in the short run is very tight, and so the labor market is tight. That I've ever seen, I mean, my age, yeah, maybe. I mean, I think the late 90s had a tighter labor market than this. I would not say that 05, 06 had a tighter labor market than this, but we haven't really had an extremely tight labor market since before that. I mean, the late 90s was somewhat tight. You had macroeconomic margin pressure from labor costs, but it was being offset by strong revenue growth and strong nominal GDP growth at the economy level, 98, 99.
Yeah.
So you really have to go back to the 80s and before where you have something more pronounced. And I don't think we're quite at that level. We just have very special factors relating to the pandemic. I do think that structurally we are moving towards a tighter labor market with better persistent wage gains for lower wage workers. I hope that's where we're heading. I think that's where we're heading. I think that's where policy is directing us. But that's a little different from the pandemic, and it's going to take a few years to truly see whether that's the case.
James, John asked the question rightly earlier, and I'm sure that I completely bungled the answer when he said, well, what do you make then of this low participation rate, given the fact that so many people haven't come back into the market? How can we say this is such a tight labor market? I don't know. I fumbled around. Can you give a better answer than I gave, please?
Well, I mean, the labor market means a tight labor market means there's upward pressure on wages. So a supply restriction, even if it's only going to last a few months or a few quarters, can give us a tight labor market where wages in certain industries go up. In leisure and hospitality, they appear to be having those issues at the moment, and wages are rising. But I would separate that kind of short-term high-frequency factor related to returning to life in the end game of a pandemic from the structural situation. And if we go back to 2019, there were signs of a somewhat tight labor market for the first time in many years.
Yeah.
And I think when this thing is over, we're going to be back in that. So it's not going to be as tight and as acute as we are now, but it's going to be profoundly different from what we got used to in 2017 and the many years before that. And I think that's very important.
James, just to conclude, this is such a delicate balance for the Federal Reserve going into year end. If these supply-side issues persist into year-end, and we have 12 months of the Federal Reserve saying it's still transitory, it's supply-side issues that will heal, don't they risk this becoming part of what Fed Chair Jay Powell himself has said? It becomes part of the inflation process the longer it goes on, doesn't it, James? And I just wonder, even if it is just a supply-side phenomena into next year, how the Fed responds to that.
Well, it would be part of the inflation process if you get that, if the supply problem is really acute. But keep in mind that by definition, that means strong wage growth for a lot of lower wage workers. So workers who are choosing not to enter are an issue for the growth rate of the economy. But workers who urgently need to enter and are seeing strong wage growth. And I'm not sure that is going to be a major macroeconomic problem. So it will be disappointing growth, but it will be wage growth. It will be strong income growth for a lot of households. And eventually, some of those, it's not necessarily the worst thing in the world if we get this, because the jobs are there.
James Sweeney, good to catch up, sir. As always, at Credit Suisse, the chief economist, James Sweeney, there on the current situation in the U.S. economy. Every day, Tom might mention a man named Harry. And if you have no idea what Tom is talking about, Tom decided he supports a club in North London called Tottenham Hotspurs, and their best player is called Harry Kane.
He's okay.
And Harry Kane's threatening to leave. And Tom, we have an exclusive coming from the Daily Mail that Harry Kane is isolating after jetting home from a break in the Caribbean and can only return to training with a negative COVID test at the end of the week. So he's missed training the last couple of mornings. A lot of speculation about why. Maybe he was pushing a transfer, Tom, to perhaps Manchester City. The Daily Mail says he's isolating after a vacation.
Thank you.
We've cleared that up. Okay.
We're still going to be talking about it. You think that we're not going to talk about it?
I have no doubt we'll be talking about that through the next couple of weeks. Coming up on the Open, Wei Li of BlackRock, Global Chief Investment Strategist, not on Harry Kane, but on this market.
Lily Parcheesi. She plays Parcheesi. Wei Li grew up.
I'm not going to ask her, Tom.
Great.
Ask her.
Shock. Lisa Bravitz, Tom King, Jonathan Ferro on radio, on TV from New York City. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. President Biden and top White House officials are trying to stave off a wave of evictions. A federal moratorium on evictions just expired, and the president is pressing federal, state, and local government agencies to act quickly to stop tenants from losing their homes. The chair of the Securities and Exchange Commission is preparing more oversight of cryptocurrencies to protect investors. Gary Gensler has unusual expertise in digital assets, but in an interview with Bloomberg, he signaled that he's not on board with the hands-off oversight approach many enthusiasts would like to see. He says that investors must be protected against fraud. And Standard Chartered overcame economic headwinds across Asia to beat second quarter forecasts. That's allowing the bank to buy back shares and plan a small dividend. We spoke to the CEO, Bill Winters, in an exclusive interview.
We'll then have plenty of capital to continue to invest, either organically or inorganically. So if we get some interesting acquisition opportunities along the way, we'll have the capital to do that. If it turns out that there's nothing out there for us to invest in, which would be a bit disappointing, then of course we could resume buybacks or increase the dividend.
And Standard Chartered is expecting full-year income to be in line with last year. KKR has crushed its fundraising record by bringing in $59 billion in the second quarter. It was driven largely by the initial closings of the latest North American buyout fund, Global Infrastructure Fund, and Core Private Equity Fund. KKR's managed assets nearly doubled from a year ago to $429 billion. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Some of the best deals in history have been passed on by a very large number of people. The money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
The thing that's different about China today, in contrast to the last 40 years, and most of which I've spent going over there, is that they now remember that they're communists. And when they remember they're communists, you end up with a situation where you're not doing things as they've been doing for the last, which created Alibaba, which created the opportunity for people to make tons of money. They're now becoming political.
Michael Holland on China, the changes in China, and of course that folds into all of American technology, and that includes a team from Cupertino. Dan Ives joins right now. I'm very much bullish on Apple and other tech stocks with Wedbush Securities. Dan, I know that Lisa's got some interest in the China story. I need you right now to reaffirm 185 and how your path gets out to 200 and 250 on Apple. And the major thrust I have is in this pandemic, in securities analysis, how far out can you extrapolate the Cupertino experiment? Do you go out 6 months? Do you go out 18 months? Or do you have a terminal value out, say, 3 years?
Yeah, well, when I'm looking at 185, and I do believe that could be conservative as this all plays out, it's really some of the parts. I mean, the services business, called $70 billion annually, I think that starts to get to 80, 90 billion. That's worth $1.5 trillion. That services business. And then ultimately the hardware business, the iPhone, given what we're seeing on the growth on the super cycle, I know it's worth another $1.5 trillion. I think we have a $3 trillion market cap a year from now.
Within this optimism, Dan Ives, is the great miscall of everyone, including me, and that has been margin resiliency. What have you learned about technology in America and their ability to sustain margins?
I mean, that's really been one of the key parts of the story over the last few years. Their margin expansion, both from a manufacturing perspective, but even from a price perspective in terms of what they're passing to the consumer, has really been jaw-dropping. You're continuing to see those margins flow to the bottom line, and that's why they're generating, called 60, 70 billion a year of cash. And that's going to continue to happen. Ultimately, I think we could be at 100 billion as we look out 2 to 3 years. That ultimately is why this continues to be a renaissance of growth in Cupertino.
All right. The path to a $3 trillion market cap, that's about $600 billion more than it is now for the Cupertino experiment, as Tom calls it. This really leans on growth in addition to just services revenues and other streams of profit. And part of the growth has stemmed from China. How do you partition out their presence in China at a time when the tech war between China and the U.S. is heating up?
Yeah, and for Cook, that's really been probably one of his best achievements, that they've been able to navigate this U.S.-China cold tech war for a company that produces all their iPhones in China and 20% demand is in China. But the one thing you have to remember, they are one of the biggest employers in China as a country on a peak iPhone cycle. And from a demand perspective, and this is really the crux, they continue to accelerate iPhone demand and purchase cycles within China. And that's really been the key to the Apple story.
Dan, we're talking about this on a day, yet another round of regulatory crackdown, or at least the perception of it, in China on big tech. There was a state-sponsored media article about the opium of video games and the concern that they have around kids spending too much time on them. We also talked about, we heard about a crackdown on auto chip manufacturers in that country. How do you parse out how much this will affect U.S. companies operating in China, as well as the fund flows into big tech more broadly throughout the nation, throughout the world, frankly?
Yeah, it's a great question. I think when it comes to Apple and Tesla in particular, they continue to be more Teflon-like in terms of how this is going to impact them. Remember, China, the regulatory crackdown on Chinese companies domestically, we've seen it from Alibaba to Didi and others. We believe money is massively rotating from Chinese tech to U.S. tech. It's hard to own Chinese tech today. You don't know what's going to happen on the regulatory in a given 24 hours. This is going to further drive U.S. tech stocks. It's our view 16,000 NASDAQ, and it's just been a black eye for Chinese tech stocks, and as these things continue to come out of left field.
Dana, as the hallmark of Apple, the distinction rather has been their use of cash. I look at Michael Pachter's work at Wedbush on Amazon, and there's some other tech stocks as well. But is the tone of Apple on share buyback and even dividend, is that transferable to techie companies that have never done big share buyback and that don't have a dividend?
Yeah, well, I think if you look at Apple, I mean, they've been pretty clear about their capital allocation. I mean, really going net neutral, and that's why they're going to continue to spend $100 billion on buybacks. But also, the difference between Apple and others, they're not acquisitive, right? Many, and we see with Square and others, tech companies are acquisitive. Apple has not been, and that's part of that DNA of Cupertino to build it themselves, and that's how they become at the top of the heap right now, you know, really across every company.
Dan, before we let you go, you have been a big bull on Apple, on big tech in the United States. You have been right again and again. What would you have to see to start perhaps rethinking your call?
I mean, for me to rethink the call, the digital transformation story would have to be significantly go the other way. We'd have to start to see significant reduce in spending across enterprise, across consumer. But right now, Lisa, we see the opposite. I believe we're only in the middle innings of a tech bull cycle, given all of our checks. And that's why, to me, it's a green light to own U.S. tech across the board going the second half of the year.
Dan Ives, thank you so much. With Wedbush Securities this morning. You know, Lisa, I look at the news flow today and the individual stories along with the greater view as well. And it's just this COVID news flow centering around vaccinations, centering around what government officials are doing. And you mentioned it earlier. I mean, the basic idea here of August 3, get out the calendar, kids back in school.
Yeah, and the question is, can they get back to school in person consistently without any further disruptions? As you start to get masks being mandated in more places, as you start to get the Delta variant surge that's actually transmissible even among vaccinated individuals. Look, I think we can't overstate how important it is for kids to get back to school. I am talking on a personal level, but I'm also talking on a social level, Tom.
Yeah, and the answer is maybe that's where you solve masks. I mean, we may have masks at selected stores. We may, you know, I walked in I don't know where it was last night. I walked in someplace where I felt like an idiot. I didn't have a mask.
No, I know. Right now, you need to have a mask when you go into places. And I will tell you that my kids actually just went back to school, don't ask, very early. And they all are wearing masks. They have to wear masks in the classroom.
You are so pushy. You are so rushing your children. What do you got them doing? Linear algebra here? The early program.
I'm having them do my expenses for work. When we go out to some random, I don't know, where do you go? You said you go to McDonald's. Right.
Yeah, well, yeah, we go to McDonald's. And
where they mandate masks now. No, look, I think
if
that the
I keep
other
it
theme...
under $19, I don't have to, show a receipt.
I think that honestly, though, the idea that private companies are taking the lead here is really interesting.
Futures up 9, a little weaker than what we saw earlier. Futures make a 10. Dow futures up 91, I should say. Good morning, John Farrell. The VIX back above 19, 19.09. Please stay with us through the day. On Balance of Power, the gentleman from Columbia, Dean Hubbard. Good morning.
An exceptional Q2.
It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Live from New York City for our audience worldwide. Good morning, good morning. Equity futures up about 0.25% on the S&P. 30 minutes away from the opening bell. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York, we begin with the big issue, building division at the Fed.
There is a lot of jawboning.
What Brainerd is doing here is really sending a clear signal.
Brainerd, I think she probably wields more
influence at the Fed right now?
For Brainerd, clearly it's going to be what happens in September in terms of tapering.
I was a little surprised that Bullard is actually talking a little bit more hawkish.
They're going to be as aggressive as what Bullard is suggesting. And
all they have to do in the next couple of meetings is, when the time is right, insert the word substantial.
The Fed, let's face it, with its semantics, it's nearly there to announce this tapering.
If you think about the incentives for Jay Powell,
the Fed's going to sit and wait, see how things evolve.
Going in, we had 3 very outspoken Fed presidents.
We could continue to see commentary from Fed officials.
Joining us now, the panel, BlackRock's Wei Li, TPW's Jay Pawlowski, and Will Ryan of Granite Shares. Wei Li, I want to begin with you. What do you make of this emerging division at the Federal Reserve?
Well, what we have seen so far is more of the hawkish voices coming out, and it would definitely appear that we're getting closer to the announcement of taper. But what is really important to distinguish is that taper does not equate to liftoff. There is no automatic process there, and taper does not equal to taper tantrum. So markets can stomach this.
Jay Pawlowski, Vice Chair Rich Clarida, he speaks tomorrow. How important is that?
Not very, John. I agree with Wei that this is really not all that significant. The Fed has made it extremely clear it's going to taper at some point in the near future. Their asymmetric inflation targeting system is data dependent. There's absolutely no pressure from any bond vigilantes. In emerging markets, central banks are already raising rates. Thus, there is not going to be a taper tantrum. I don't really think the Fed is a big deal here at all.
Will Ryan, is it that simple?
Yeah, I think so. I think another factor is just that, with these numbers, with the inflation numbers that we're seeing in the economy, it gets harder to really ignore that. As we go on and we keep seeing these persistently high numbers, it gets harder and harder to ignore it. So, as Jay said, we're going to see some tapering at some point. And if we start getting these numbers at elevated levels, 5% plus into September, October, we could well be seeing tapering sooner than we think.
You guys make it sound easy, that's for sure. Governor Waller sounds like he's on board. This is what he had to say to CNBC in the past 24 hours. Quote, I think you could be ready to do an announcement by September. That depends on what the next 2 job reports do. If they come in as strong as the last one, then I think you have made the progress you need. Let's bring in Michael McKee for more. Morning, Mike.
Morning, John. Well, there are 18 members of the Open Market Committee, so divisions are not unusual. It is a bit unusual, though, to see them at the Board of Governors. While Waller has been saying that maybe we need to taper sooner for some time, Lael Brainerd earlier this week, as you mentioned, taking the opposite view, saying recent high inflation readings reflect supply-demand mismatches in a handful of sectors that are likely to prove transitory. Of course, that's the party line. At his post-Fed meeting press conference, Chairman Jay Powell said of tapering, we're not there, and we see ourselves as having some ground to cover to get there. So how divided is the Fed? Well, no Fed governor has dissented since Mark Olson in September 2005, and it seems unlikely now. And the composition of the voting membership, you take a look at who's voting this year, suggests Powell's view still has strong support. New York Fed President John Williams firmly in the inflation is transitory camp, as is Richmond's Barkin and San Francisco's Daly. Atlanta's Bostic and Chicago's Evans have also agreed we are not there yet. The strongest proponents of an early taper, Bullard, Rosengren, Harker, and Kaplan, don't vote this year, so they can express their opinions, but they're probably not going to sway people. So how to read all this? Well, Waller gave us the roadmap, and you read it there, John. Watch the data. While he sounds hawkish, he did predict an early taper based on the next 2 jobs reports, Friday and September 3rd. We'll also get a number of inflation reports. Bottom line so far, it's debate, not dissent. Jim Bullard, who is advocating an early taper, summed it up to Reuters today, saying, what I want to be prepared for and get the committee prepared for is the risk that this is an unpredictable situation.
Debate, not dissent. I do like that. Michael McKee, thank you very much. Mike McKee, on the latest data, we can run you through the payrolls as I pour my water over the studio floor. Let me get to the data very quickly for you. Looking for payrolls this coming Friday. Payrolls 720, that's private payrolls. 875 is your estimate right now going into the jobs report. The ISM out in the last 24 hours, and I just wanted to pick out some of the industry comments. Highly anecdotal, I know, but just take a little look at some of these. Business levels continue to exhibit strong demand with no signs of backing down. The second comment I thought was really important. Supply chains are slowly, very slowly filling up like a water hose, starting upstream and slowly flowing downstream. Let's bring in the team for a little bit more on this. Jay Pawlowski, I just wonder, from your perspective, the supply side of this economy healing through the year ahead, to what degree do you expect that to happen?
Pretty much fully, John. I think we're in a gradual process. We're moving from a staggered reopening to a synchronized global expansion. The data in the U.S. continues to be robust. In fact, the Q2 disappointment is down to inventories. That actually sets up a stronger than expected second half of the year. Better economic data globally. Europe better than expected. Japan even better than expected. So I'm in the camp that inflation is transitory. I mean, it's going to be 2.5% to 3%. Not going to get to 5%. Not going to sustain at 5%. And so for me, we are moving from peak growth year over year to normalized growth. We're in the first year of an economic recovery. I think we've got multiple years to go.
Peak growth to normalized growth. Wei Li, can we say the same about inflation?
We actually are of the view that, yes, inflation as related to restart dynamics could be transitory, but in the medium term, inflation is actually underappreciated by markets because of incredible amount of policy support, because of shifting supply chain, going from previously focusing on cost efficiency to now focusing on resilience, and that would have inflation implication. And also the fact that in the longer term, we do not see rates pushing a lot higher from here, because at that point, the rising debt level may not be affordable anymore. And this is what we call fiscal dominance, and consideration around fiscal dominance would actually create a path for inflation to push higher. So we are very much of the view that inflation in the medium term can push higher, and that is somewhat underappreciated by markets.
Will Rand, your reaction?
Yeah, I think I'm more in that camp in terms of it gets harder for me to believe this is really transitory. You know, the longer it goes on and the pressures you see, if anybody's tried to buy a home, if you tried to buy a car, if you tried to buy a boat, if you tried to buy groceries or go out for dinner, these prices are higher. And I think the one big X factor for me that, is so important here is the number of people on unemployment in the economy that's obviously still COVID related. And when those unemployment benefits cease, really how many of those people return to the workforce and how quickly they return to the workforce. That's a big X factor out there, and that's holding back a lot of employment. There's also some immigration related issues as well. But I think for me, it's hard to believe at the moment that this is really transitory. Everywhere I go, I see help wanted signs. I think that there's real signs here that there's real pressures on employment.
A bit of daylight between the three of you on this call then. Will Rand and Wei Li on the side of pushing back against the transitory call. Jay Pawlowski going with it. So I just wonder what divides you in terms of the market calls as well. Jay, just give me your view, your market call, just very briefly in 30 seconds, just the brief conviction view that's aligned with that view that you do think it's transitory.
Sure. I think the Delta variant is going to be defeated by the vaccination production and surge of vaccinations. I think we're approaching the turn away from growth and lower rates to higher rates in cyclical value segments of the market, as well as non-U.S. equities and commodities. I am considerably bullish, particularly for the non-U.S. DM, Europe, which, John, I've liked for a long time, as well as Japan. Yep. And in emerging markets, I like Latin America.
Wei Li, what about you?
Well, actually not that dissimilar in terms of asset allocation view, in that we have also recently become more favorable for international equities, specifically looking at Europe, specifically looking at Japan. In U.S. equity markets, we are currently neutral, recognizing that some of the earlier underperformers in the year, like quality, like growth type of names, have room to catch up. And in fixed income, we're underweight U.S. government bonds, but for duration exposure, we prefer inflation-linked bonds because of our view on inflation.
Well, Ryan, your take?
Just going through, what is an incredibly impressive earnings season, yet again, and a lot of people saying that, 1 quarter, 2 quarters ago, the tech stocks were overvalued, and yet they've continued to deliver these incredible earnings. So I think the economy is in a strong position right now. positive definitely on the equity market, positive on the commodity market. I think fixed income is really the only negative here. With negative real rates the way that they are, very hard to be positive about fixed income. But I think elsewhere in the market, things are looking very strong.
We'll build on that through the program as we work our way to the opening bell. Got to get you up to speed on some of the news, some of the corporations in America and how they're responding to this surge in Delta variant cases here in the United States. With more on that, here's Katie Lyons. Hey, Kaylee.
Hey, John. Well, in a lot of ways, it feels like we're going back in time because with the Delta variant surge and the new CDC guidance about even vaccinated people wearing masks indoors, you are starting to see mandates come back into place. That is true on the public sector level, with the Bay Area now reinstating its mask mandate as of today, and Louisiana putting one in place until September 1st. The governor citing an insufficient vaccination rate. Here in New York, that's not a full mandate. Mayor Bill de Blasio just says he strongly recommends wearing masks, but private companies are taking action on their own. Target now requiring face masks for team members, joining the ranks of a number of other companies who have instituted similar policies. And it's not just mask mandates either. Vaccine mandates are starting to roll out as well. Tyson Foods, the latest to require vaccinations for its U.S. workforce. And of course, the situation is worse in some places than others. John, states with a lower percentage of the population vaccinated, seeing some of the biggest daily increases. Easily topping the list is Florida, which reported more than 110,000 new cases in just the last week. You have California, Texas, Louisiana, and Georgia on that list as well. The question is to what extent and how quickly new restrictions and mandates can stem the most recent surge, because right now the curve of average daily COVID-19 cases in the U.S. is really rapidly rising right now, back up to where it was in mid-March, John.
Kelly Lyons, thank you very much. Can we take some comfort from what is happening in the United Kingdom? This is what Morgan Stanley's had to say. The following quote: in the UK, a reasonable template for the US. Hospitalizations remained low as cases spiked. The economy reopened anyway, and ultimately cases have started receding, suggesting overstated downside risk from COVID-19. So a question for all three of you. Is the UK a reasonable template for the US? Is that your interpretation of things as market participants? Jay Pawlowski, first to you.
Yes, John, the issue of the Delta spread versus the vaccine surge has been the key tactical issue for us over the last couple of months. I think we fully discounted the Delta variant 2 weeks ago with our turnaround Tuesday. And I'm looking for a short life cycle, as we've seen in the UK and India and elsewhere. And I think in the next couple of weeks, this is going to be revealed to be a passing issue. And the good news is, John, as far as I know, there's no other major variant beyond Delta. So we could actually be approaching the end of this whole thing in the next couple of weeks, in my opinion.
Will Ryan, do you agree?
Yeah, I'm glad you brought up the UK, John, because I was going to say, if you hadn't brought that on your segment, that would be a good template and a good place to look. I think the one thing, obviously, is, as we know in the UK, the number of people vaccinated, per 100 people is very, very high. So I think that definitely helps. Sweden's another country I'd throw in there. I think another country that has had less restrictions, but seems to have reopened and conquered the Delta variant so far. So again, early to tell, but I think it is a good guide as to how we should expect things to play out here.
Weili, final word.
I would say that, yes, we pay a lot of attention to the UK experiment, but here the caveat is also that with the school holidays, there is less testing, and also the warmer weather may have contributed to the decrease in new cases reported as well. So, yes, we pay attention to it. Yes, it is a template that we're looking at, and as a result of that, we are of the view that the Delta variant represents a delay in the restart narrative rather than a derailment of the restart narrative, but we recognize that there are caveats to the UK experiments.
A delay, not a derailment. Weili sticking with us alongside Will Ride and Jay Pawlowski. Let's get you a check of this market. Equity futures up 0.2%. Looking at some of the movers ahead of the opening bell, here's Katie Greifeld.
Hey, John. Well, Chinese stocks are falling again, this time in the country's gaming sector. That's after Chinese state media railed against the spiritual opium of gains. As a result, Tencent is pledging to limit playtime for kids, and that is hitting shares pre-market, along with ADRs for Bilibili and NetEase. And, John, it's not just Chinese gamers. U.S. video game makers are also in the red pre-market, given that China is very important to the bottom line of those companies. EA and Take-Two both falling before the bell, as is Activision Blizzard. And we just got headlines that Blizzard president J. Allen Brack is leaving the company amid its labor lawsuit. But moving on to earnings, ZoomInfo, DuPont, and Under Armour are all rising after beating estimates. All three of those companies also lifted their outlooks, which you haven't seen a lot of this season. Clorox, however, it's bringing up the rear. It missed sales estimate and forecasts a slowdown from here as that pandemic boom fades, John.
Katie, thank you. Coming up on the program, two quotes for you. Spiritual opium and electronic drugs. How those two lines there, right there, shook up Tencent overnight. We'll cover that next. From New York, this is Bloomberg.
Countdown to the opening bell is brought to you by Workday, the finance, HR, and planning system for a changing world.
Competition beat us again.
How?
They have a better finance system than we do.
I feel like they might have a better finance system than we do.
Workday.
How do they make better decisions faster?
Workday.
It's gotta be something.
Workday.
I think I got something.
Work.
Rob, I think
Hey, Rob.
Yeah, you're on mute.
You're on mute.
Hello.
There you go.
Hey, there he is.
Workday, the finance, HR, and planning system for a changing world.
Overnight, calling online gaming spiritual opium and electronic drugs. Before removing the online link, the print edition, of course, still exists. The stock, Tencent, got absolutely hammered in Hong Kong trading, reversing some of the losses in the pre-market here in the United States. I want to bring in Damien Sasser of Bloomberg Intelligence. He joins us now for more. Damien, for you, what is going on in China? Because every single morning, a lot of people are struggling to get a read.
You know, I think Michael Holland said it best earlier on your show. China is remembering that they are, in fact, communist. I mean, this whole concept of controlled capitalism, I mean, throw it out the door here. I mean, we've now seen Tencent, lose 400 billion of market cap since its February high. I mean, these recent, don't get me wrong, I have 3 children, Jonathan. You know, I could use a little bit less spiritual opium here in my home. But, you know, what's going on there is just relentless. The scale, the breadth of the recent crackdown from Beijing is absolutely relentless. But the one thing that's held up well amidst it all is the dollar-yuan cross rate. I mean, the yuan is at 646. It's actually strengthening. So I don't want to talk about funny business going on there, but in recent drawdowns that we've seen in Chinese equities, the yuan has followed suit, and it's not doing that this time around.
So hang on a minute, Damon. You think there could be some kind of intervention keeping this currency stable as we get these equity jitters cleared?
I'm not going to get backed into a corner here, Jonathan. I know nothing. All I know is that the yuan is appreciating, and in past times it has not. I think we have to kind of also take a step back and look at the potential for contagion into the broader emerging market complex. What's happening this time around, unlike in recent memory, we're seeing decoupling. China 5-year credit default swap spreads have risen from 28 to 39, over the better part of the last 4 months. EM 5-year CDS spreads are going in an opposite direction. They're actually compressing and tightening, which means that things are getting healthier in emerging markets, even though things are getting a little bit less so in China. So that's an interesting development that we're keeping a close eye on.
You alluded to something, Damien. I was just wondering if you knew something. That's why I followed up. Not to trap you. Damien Sasser, Bloomberg Intelligence. Damien, thank you. Still with us, Wei Li, Jay Pilowski, Will Ryan. Wei Li, I wanted to come to you first because you said something really interesting in your notes. You think this will go on for years, but the intensity will vary. And between episodes, we'll get some softening of monetary policy, of fiscal policy maybe as well. Can you just walk me through your framework for thinking about this market at the moment?
Absolutely. We are of the view that the hawkish stance, the tighter stance in China, that is really part of a long-term quality revolution. And this will go on for years. But what we have recently seen, as evidenced by the Politburo last week, is that against the potential risk of market instability, economic instability, we're seeing policy in the near term starting to become a bit more supportive, starting to become a bit more dovish. So both on the monetary side and as well as on the fiscal side, we expect policy to ease against the broader hawkish backdrop, long-term ease going into the year end. And in terms of the regulatory tightening, the Tencent example is the latest example. But as you said, that the article itself was taken off and then reposted with less of the fiery language and the opium characterization. So there's a bit of a back and forth here. But what is really important to understand with regards to China, oftentimes is that you have 1 step forward, 2 steps backwards, and then 3 steps forward. This zigzag is what we should expect. Now, what does it mean for asset allocation and investment? We do see investment opportunities emerging in the market that has sold off quite a bit, but we're still neutral right now, tactically neutral on China equities more broadly, but identifying selective opportunities that can benefit from the easier policy that is coming, but not so much in the direct fire line of the regulatory tightening. And when it comes to China rates, because of the easing expectation, we're overweight China rates.
Very constructive on a series of issues at the moment. Jay Pilowski, just quickly, a final word from you on China. A lot to worry about. Is there an opportunity here?
Yeah, I think it's been discounted pretty effectively. The China ETFs that I look at, John, are massively oversold after last week. And I would point out that financial stability remains the key for whatever system China offers. Financial stability is the key. And to me, the focus should be more on high-yield property developers such as Evergrande to really watch in terms of financial stability and risk to China. I completely agree. The PBOC has bullets and will use them if needed to stabilize the situation.
Jay Pilowski, Will Ryan and Wei Li sticking with us. We'll get Will Ryan's thoughts around the opening bell on this equity market. Coming up next, the morning calls and later, division on Wall Street. Equity strategists entering August with a broken consensus. That conversation still ahead. From New York, this is Bloomberg.
said was we need to make them in America. Does that include overseas companies making them if they have the plant in America?
I would certainly be in favor of them having operations in America, absolutely. You know, Samsung, TSMC, there are companies that are in allied countries, and you know, we certainly want them operating in America and producing chips in this country, yes.
So we have a significant chip issue, but there are other supply chain issues as well. As I know you're monitoring what's going on. Where have you seen other problems in the supply chains right now in the United States that need to be addressed?
Particularly in home building supplies, you know, lumber and all the related supplies, glue, adhesives, and you see it playing out. You know, home prices are high. If you go to Home Depot or Lowe's, you'll see prices are a little bit high, and that's all because of the lack of supply, just disruption.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
On the S&P 500, the Nasdaq up a quarter, the Russell up a third. From New York, your opening bell is next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
25 seconds away from the opening bell in New York City this morning. Good morning. Let's get straight to the price action on the S&P 500. Futures positive 9 points. On the S&P, we advanced 0.2%. Outperformance on the Russell, just the small caps advancing about 1/3 of 1%. That's the opening bell. Switch up the board and get to the bond market. Your 10-year yield shaping up as follows: 117.22. Your 2s10 spread. That curve is flatter. The spread between the two, sub 100. Earlier on, 99 handle. Outside of that, into the foreign exchange market, 118.76 on euro dollar, unchanged. Crude moving lower by a little more than 2% to 69.72. That's the cross-asset price action at the market desk with your movers. Back with us, here's Katie Greifeld.
Hey, John. Well, it's all about investor paybacks as big oil reports, and BP is an early bright spot, boosting its dividend by 4%. That's giving shares a lift. ConocoPhillips, though, no such luck. It beat estimates, but it didn't announce any further buybacks, and shares are being punished pre-market. Meanwhile, autos are broadly in the green. That's after Jeep owner Stellantis posted a beat and raise quarter, lifting its full-year profit outlook. That's dragging the sector higher and helping Tesla founder Elon Musk pass Jeff Bezos on the wealthiest list. And finally, turning to the M&A space, Sanofi opening lower after buying Translate Bio for $3.2 billion. That's a bet on mRNA technology, and it's pushing Translate higher by a whopping 29%, John.
Katie, thank you. Thank you very much. Your market opening higher. We advanced 1/4% on the S&P. Financials leading the way. Despite what's happening in the bond market, we advanced there by about 0.5%. 4,700. That's the year-end price target of Oppenheimer's John Stolfers. This is what he had to say earlier on today.
It's that resilience of equities that we're seeing, the fact that we've got earnings momentum here, that even as the dramatic comparisons begin to ebb in the third and fourth quarter, will still show that companies are maneuvering very uncertain times. A lot of it done by, of course, use of implementation of technology and the innovation that comes with that.
Back with us, I'm pleased to say, is Bloomberg's Katie Lyons. Hey, Kaylee.
Hey, John. Well, Stolfus obviously the most bullish on the street, seeing a little more than 300 points worth of upside here. And of course, followed behind him are 3 strategists that see the index ending the year around 4,600. In total, 8 of them expect us to go higher from around the 43.95 level where we trade today. But the average year-end estimate is down at 42.78. 13 strategists expecting us to go lower. The most bearish being Barry Bannister over at Stifel and Savita Subramanian over at Bank of America, who both see a drop down to 3,800, which would represent downside of around 13%. Now, one of the downside risks that Subramanian sees is on margins. She is expecting them to be weaker in the second half because of, no surprise, inflation. She's pointed out that mentions of inflation on second quarter earnings calls are up 1,100% on a year-on-year basis, most notably mentions of labor inflation, but you have supply chain and materials inflation coming up a lot as well. And obviously, in the face of the second quarter, though, margins have held in and earnings have been quite strong, which is a large part of what is giving fuel to the bulls, and the reasoning that Binky Chadha over at Deutsche Bank gave for raising his own year-end target from 4,100 up to 4,500 last week. He and the team said second quarter earnings have increased their confidence that profits will expand more than expected throughout the remainder of the year. Of course, John, more than 87% of companies in the S&P have surprised to the upside this earnings season. Average earnings growth of about 98%, John.
Kelly, thank you. Let's bring in the panel. BlackRock's Wei Li, TPW's Jay Pulowski, and Will Ryan of Granite Shares. Will, I want to come back to you around the open. 4,700 on the S&P. I caught up with Wells Fargo earlier this morning looking for 3850. What kind of developments are you looking for in U.S. equity markets?
I think continuation of what we've seen, John, and that's, positive growth. I'm not saying, 4,700 necessarily, but I think you just said it in the last segment, which is the majority of companies that are reporting earnings have really been fantastic earnings. And so just to me, that demonstrates the strength in this market. And with the employment situation, the unemployment situation, and people coming off benefits, I think that further strengthens the supply chain here. I don't think the inflation is a big concern right now on margins. So I'm very positive about the market right now to the end of the year.
Wei Li, you expect the inflation forces to persist. But then when I asked you where you'd be positioned, you were still talking about international. Can you run me through where the U.S. story fits into all of that?
Well, we're currently neutral U.S. equity market, which is still the biggest part of our clients' equity portfolio. So neutral is a big weight. First, I would say that, and second, we do think that markets can push higher from here. Thinking about the combination of above trend growth as well as still very negative real rates, there is a good and potent mix for risk assets to push higher. Now, having said that, I do think that the reporting of this segment is actually spot on. You talked about earnings and sales hitting very high levels. In fact, the beats are the highest since 2011. But you also talked about margins, S&P margin hitting all-time high, right? So the question is, can margin persist and sustain? And if you think about catalysts driving margin to this very high level, low cost, low interest rate, low tax, low, well, both costs, labor and production costs, one wonder if this can continue, right? So we think that we have to focus on companies and sectors that can have a strong pricing power, that can pass through costs. And here, sectors like technology stands out.
Jay, can you afford to turn your back on U.S. equities?
Well, I have so far this year, John, and so far so good. We're underweight U.S. equities, though I have to say the U.S. has a couple of things that stand out. One, and this is global masterclass in discounting and popping little bubblets. Every time we have two reasons to sell off in the last couple of weeks, Delta and China, and boom, pop right back up to new all-time highs. Part of that's the twin engine nature of the U.S. When rates go up, cyclicals and value outperform. When rates go down, growth outperforms. We're now at a point where growth is the most expensive versus the broad market in 50 years, and the value ETFs had record outflows last month. I think we're about to make the turn. We're going to see higher rates as we go through the second half of the year. Cyclicals and value are going to outperform. And in the non-U.S. markets where we're overweight, particularly DM, we continue to like Europe. And we think Japan is set up here to really perform in the next 6 months and perhaps lead the way. And in EM, we continue to like Latin America, where we think the relationship between commodities and stock prices will reassert themselves as COVID fails.
Jay, hold that thought. Developing story here in New York City I want to get up to speed on. With more, here's Kelly Lyons.
Hey, John, this is a report from the New York Times that Mayor Bill de Blasio is set to announce that you need proof of vaccination for indoor dining as well as gyms here in New York City. Apparently, these plans will be announced this morning on Tuesday, requiring proof of vaccination for people participating in indoor activities. That includes restaurants and gyms as well as performances, John.
Just some changes developing here in New York City. And Kelly, thank you. Jay, I want to come back to you on this story because the airlines and the likes of the airlines have taken a bit of a hit over the last several months. I wonder if we can rebuild that recovery trade if we start to deal with things a little bit differently.
Yeah, I think, John, you're absolutely on point. Look, I would just say I'm an Equinox member. We got the notice 2 days ago that we were going to be required to show vaccination. So the mayor is following the private sector here. And you're absolutely correct. Part of the point, John, is that the cyclical and value segments of the market have already corrected. XLE, the oil majors, is down 16%. I mentioned the value ETFs, record outflows. Jets is a perfect example with the airlines. I think we made the low on these things 2 weeks ago with the big scare on the Delta variant. I think all that we're hearing now, all this does is cap the upside in the near term. It's not taking us lower, John. The bears have already sold. I think there's been a lot of opportunities to sell in the last few weeks. People were underweight or neutral on equities, and I think the pain trade is definitely higher. Poor seasonality, which is everybody's excuse for not getting invested right here, is going to go the way of sell in May and go away, which has definitely not worked so far this year.
Yeah, there's the headline. Just to reiterate, emphasize and repeat, New York City to require restaurant customers to show vaccination proof. Wei Li, it's a very New York-centric story, but others are following. Others have already done the same thing, and I wonder what it also means for your take on the recovery story that really started to stall several months back.
We do think that there's more to the recovery story. You can play it like how Jay described it through value, but we prefer to play it through international equity markets. So the way that we see things is really that peak growth acceleration is broadening out, is moving from the US to Europe, to Japan, the rest of developed market, and that's how we would prefer to play the restart story.
What about you, Will Rind?
Well, I said before, John, I mean, I think very positive on commodities. That's been a big focus for the year. But I think in terms of equities, instead of value and growth, I'd frame it slightly differently. I think what we're seeing is a dislocation between fundamentally good companies and bad companies. Good companies, companies that are able to pass on any kind of inflationary pressures to customers, those that can hold their margin, if not expand their margin in these times. Bad companies, companies that aren't able to do that, or companies that are too sensitive to interest rates, maybe they've got too much debt, etc. And so I think from that perspective, there's a real bifurcation here in terms of the winners and the losers.
Will Wright alongside Wei Li and Jay Pilowski. Guys, great to catch up. The panel working through the opening bell. I want to get you up to speed on this market too. The S&P 500 advancing about 1/10%. The Russell down by 1/3. The Nasdaq up by 1/10. Let's get you some moves at the market desk. Here's Kelly Greifeld.
Hey, John, well, let's check in with today's reporters. Just a few minutes into the session, Under Armour climbing after beating estimates and posting a strong forecast. Ralph Lauren also surging after posting strong sales. Clorox, though, that's your big underperformer. Sales missed and the outlook is grim, John. But moving on, Tencent is also falling from the bell. That's after Chinese state media published a harsh critique of the country's gaming sector. And Alibaba also under pressure after missing sales estimates. And finally, John, PepsiCo, it opened slightly higher after selling its juice brands to private equity. That came with a price tag of $3.3 billion, and Pepsi will retain a 39% stake. And competitor Coca-Cola, it's slightly lower, John.
Kelly, thank you. Coming up on the program, complications arising out of Washington. The bipartisan infrastructure bill running into an unexpected obstacle. Perhaps that conversation up next from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tianyi Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance, and more.
2022年完成空间站的在轨建造，建成国家太空实验室。之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station.
出发，是，敬礼。
China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
I assume you have a lot of people saying the food isn't as healthy as they might want it to be. Is that the biggest challenge, or just growing the company?
Ray Kroc had a famous line, if you're not green and growing, you're red and rotten.
This is very, very different from what we saw from prior rounds of fiscal stimulus. It's not really a game changer in terms of the total amount of stimulus that's coming into the economy.
Its impact on inflation, negligible, certainly near term. But the economic story here really is about capital deepening. It's about the long-term productivity story of the U.S. economy.
I think it should help markets to gain some more belief in the longer-term growth prospects of the U.S.
We're getting a lot of developments on infrastructure and some of those over the weekend, but I don't know that it's really shifted the base case.
Senate Majority Leader Chuck Schumer's plan to pass a $550 billion infrastructure bill this week, running into a potential hurdle. Republican Senator Lindsey Graham entering a 10-day quarantine after testing positive for COVID-19. Let's head down to Washington, D.C. and catch up with our Washington correspondent Anne-Marie Jourdain. First of all, Anne-Marie, and I'm sure we'd all agree, we're sending our best to the senator from South Carolina. Can you give us the update on what this could mean for the process, the move forward through the next couple of weeks?
Well, as you say, John, potentially it means that if he is in quarantine for that full 10 days and Senator Chuck Schumer is able to get a vote by the end of this week, which is still up in the air, then he would miss that vote. In the House, you can vote by proxy. In the Senate, you could not. And Senator Graham was very effective. He was part of the group that was able to get this bipartisan deal done and also was able to bring more Republicans on board in order to get the procedural vote to even get the legislation on the floor. That's one part of the issue, the logistics. The second is, of course, the fact that he got diagnosed over the weekend and he's entering his quarantine, and he was with other senators, and they were over the weekend at a little bit of a cookout, a barbecue on Senator Joe Manchin's houseboat where he lives when he's in Washington, D.C., and there is this cloud of worry that potentially there could be other breakthrough cases. So really twofold on what's going on. But today they are going ahead in terms of debating legislation and amendments that they want to see. And Senator Mitch McConnell says the Republicans are in no rush and want the chance to give as many amendments as they can to his infrastructure bill.
So, Anne-Marie, we have the $550 billion effort, the $3.5 trillion effort, then the argument about the eviction moratorium I want to get to in just a moment. Let's get to the $3.5 trillion. Where are we with that right now?
Well, right now, Senator Chuck Schumer says as soon as they pass the legislation for the bipartisan infrastructure package, they will begin immediately on the budget reconciliation. Now, they would do this in terms of amending the budget to get through their $3.5 trillion soft infrastructure package. That this is Democrat only, John. Now, where this becomes very critical and a bit testy in the Democratic Party is that you have those that are a bit fiscally more conservative in the Democratic Party, like Senator Joe Manchin, like Senator Kyrsten Sinema from Arizona, that think that $3.5 trillion might be just too much. And then you have those in the progressive left, especially in the House, that say if you're not going to go for the $3.5 trillion, then we could tank your bipartisan infrastructure agreement when that comes to our vote when they get back from their recess, John, in September.
Well, there's already tension within that party. You and I have talked about this already. Just to reflect on the comments from Congresswoman Alexandria Ocasio-Cortez in the past week. Going into the weekend, this was around the eviction moratorium expiring. She said the following: so now we're scrambling, but it could have been avoided with better communication and, frankly, more forthright leadership from the White House. That was Friday going into the weekend. Anne-Marie, where's this discussion now? What's it look like?
Well, right now we are exactly where we were, and the moratorium has ended. It's twofold, John, and there's a lot of finger-pointing in Washington, D.C. about this. But the bottom line is that the Supreme Court gave out this memo and extended it for weeks until the end of July, with Justice Brett Kavanaugh actually voting alongside many progressive justices to the fact that we should have a few more weeks for this. And in those weeks, Brett Kavanaugh, in this memo, pointed to state and local authorities that $47 billion of funding, that only $3 billion has been used.